Hey, Jason.
Yo, Seth.
We haven't done this together for a while.
I
It's
was
usually just a meeting.
excited to see it was the two of us.
Yeah. We'll have to find some stuff to talk about. I'm gonna pull up the question queue here. I guess we need to welcome everybody to what's our theme here? Earnings, clouds, chips,
Clouds, chips, and more.
virtual stuff,
Uh,
virtual world.
Anything. It's just a veritable cornucopia of stuff.
We promise to answer the stuff we know about and to try to gracefully deflect on the stuff where we don't know anything.
Yeah. I'm very quick to say I don't know. If I don't know, I just don't know.
It's actually a really important lesson for all investors, probably. It's okay not to know something.
Oh yeah. Very
People
much
don't
so.
like to admit that. And one of the other things that new investors always seem to miss, and it used to happen more in the days when everyone liked to argue on the boards, but kind of the idea, I think it was like the Ford versus Chevy versus Dodge stickers on the back of a truck with like the Calvin whizzing on another type of truck. Like people
Yeah.
would always, be cheering for their favorite stock in some, if there were two main companies, like it was SanDisk and Lexar for a long time in like the flash drive business. I always found that curious because the stock market is one of the few places where you could bet on both teams and win both ways, right? You didn't
For
have to
sure.
buy Lowe's or Home Depot. You could have bought them both and done just fine. Pepsi, Coke, same thing. So
It's what I did with Visa and MasterCard.
there
I
you
wasn't
go.
gonna sit there and quibble. I own both of them, and they've done quite well for me through the years. So,
Yeah. People pay with both, right? Pull it
can
out
I
of my
just say,
wallet.
Seth, real quick, because we're talking about investing, and this is going to be a little bit of an unconventional view here, but or an unconventional way to look at investing. I went to the dentist this morning. Just your 6-month
I'm
checkup.
going tomorrow morning.
Well, see, I like that you're doing that, and I am religious about going to the dentist every 6 months. It's just one of those things. For whatever reason, I don't know. I grew up that way. I take good care of my teeth, and every time I go, I don't like going to the dentist. It's not like an enjoyable thing for me. But I mean, I appreciate that we have that ability, right? I mean, and we have some great medical care here in the United States. But every time I leave the dentist, it's like, man, I'm so glad I did that, because you walk out of there like, hey, clean bill of health. We just cleaned your teeth. Everything's good. I mean, it's invest in yourself. And I think one of those things, folks, make sure you go to the dentist every 6 months. It's a
We'll
big
start with the
deal.
dentist.
Oral health, man, that's a real thing.
I'm behind the times. I'm late
Yeah,
for
I
mine,
just
which is
every time
why
I
I always.
leave the dentist, I don't like it going in, but I'm really glad I did it when I'm walking out.
And I guess it's quarterly dental time. I guess as far as stocks go, we have the quarterly hygiene update, right?
Sure.
We're kind of finishing up a little bit on earnings season, or maybe not. I have a my robot that writes earnings takes. It looks through whatever's filed in one of our data providers, Capital IQ, like over the past few days, and then it runs through. And if the earnings data doesn't look corrupt or weird, it spits out a summary of what they did. And I guess it's starting to wind down a little bit, but
Yeah.
but we had lots of earnings over the last few weeks. Some of them kind of weird, some of them kind of scary. And I think one of the things before we get to the earnings is that I sometimes wonder, like, how often do you think regular investors like us should pay attention? So I'm going to make an admission. Some people will probably say this is weird. Unless I own the stock and have recommended the stocks, I don't think I look at the quarterly earnings. Like, I just don't check up on them that often. I check up on the stocks that I cover for work all the time, because that's
Sure.
the job. But the stuff I just own, like, I may just check in once in a while, once, twice a year. Unless I see a headline that indicates that something funny that I didn't expect happens. Where are you on that spectrum? If you didn't have to check it for work, would you be on it every quarter?
No, I think I'm right there with you, as a matter of fact. I mean, obviously, we take care of the coverage that we need to for work and whatnot, but I have plenty of holdings that I've owned for years, and I might check in. I mean, like you said, unless there's like a headline driven event, I'll probably check in on them maybe a couple of times a year just to make sure something hasn't just completely changed or broken the thesis or whatnot. But yeah, I mean, I have plenty of companies that I'm not sitting there micromanaging and looking through it with a fine tooth comb. I mean, I kind of like to
Buy right and sit tight.
in good businesses and kind of let them do their thing. And so unless I see
Yeah.
a headline that changes sort of what I might be thinking there, I don't typically worry too much.
Yeah, and it probably depends on a lot on the kind of company. So if you're talking
Yeah.
about something like Costco, probably not a whole lot going to change from quarter to quarter. Even
Exactly.
like Walmart or Target, probably not a lot going to change. If you're in some small, say, semiconductor company that provides maybe specialized chips to some other companies or OEMs, where market movements or even economic fluctuations in the end markets could be a huge deal, then maybe you want to keep up with those a little more often, especially if they're kind of high flyers still burning cash and things like that. So
Yeah.
it depends a little bit, but yeah, for the most
No, I
part,
think that's a great way to look at it, and I think that's right. It definitely depends on the nature of the business, and I mean, it
Mhm.
also, I think, somewhat at least depends on the size of your position.
Yeah,
But yeah, I mean, I think of like a McCormick, for example, which, I mean, everybody knows I love to talk about McCormick and I use all their stuff all the time. I mean, I've owned McCormick for years. There's not much that's changing with that business on a quarterly basis. I mean, it just does what it does. And I think probably the biggest headline with something like a McCormick would be if they make an acquisition, and they do make acquisitions in order to grow their share. And so that might be one thing where you keep an eye out for something like that. But fundamentally, it's not a business that's changing all that terribly much, right? I mean, it fluctuates with consumer demand and whatnot, but yeah, it's not like they're on that hamster wheel of always having to build new chips and technology in order to keep up.
yeah, and it's not some kind of a turnaround story or something where you're checking the
Yeah,
health to see, all right, are they actually executing on the plan, or some of the really dirty value stuff that we used to do or we'd see more often. We're like, okay, did they get a reprieve on their covenants from these guys over here, or are the creditors going to take control of the company? Um, which we used to actually look at that stuff a lot. But one of the funny things we learned about that over the years was, remember during the Great Recession, the housing recession, and we had a lot of companies on a lot of scorecards that got really iffy at that point in time. They owed so much money, and we got
yeah,
everybody got really panicked, like how many of these companies are going to go under because they owe so much money and suddenly they can't pay it back. And what I didn't expect coming out of that was the lesson that, I guess I'd heard and I thought about later, which was, if you owe the bank a little bit or a decent amount of money, you're in big trouble. But if you owe the bank a whole ton of money, they're in trouble,
the
right?
bank's in trouble. That's the
And
bank's
so
problem, not yours.
yeah, and so what
Exactly.
happened was there were so many of these companies, and it wasn't necessarily bank loans, it was bonds and everything, but, like, the companies were in such trouble that there wasn't, like, a group of bondholders that was really excited to come in and, like, take control of it and try to fix it, and
Yeah.
so all of these companies that looked like they were on death watch, so many of them pulled through because the bondholders were just like, a giant haircut is gonna be way less expensive and way less hassle than, than
Yep.
trying to take control of this thing and pull the nose up ourselves.
That's right.
Anyhow, question wise, the queue is looking quiet. Maybe we should turn to earnings over the past couple of weeks. What's one company where the earnings sort of surprised you or something that stuck out on the company that you follow?
Hmm. Well, so I mean, this is going to be recency bias here, but let's just run with it because I over the weekend on Friday's Motley Fool Money radio show, I had the opportunity to interview the president of Axon Enterprise, Josh
Oh, that's
Isner,
right.
And it's the second time I've had a chance to sit down with him, and he's just a super guy, very easy to talk to, and very clearly a big fan of the company and what they're doing. And so, I mean, there were some headlines over the last couple of weeks in regard to Axon that drove some volatility in the share price. I mean, the shares sold off a pretty good bit here over the last couple of weeks. And one thing that they were talking about, there was this article that came out in regard to this Axon's relationship with a company called Flock Safety. And Flock Safety is in the business of automated license plate readers. That's ultimately their sort of number one technology, and they've partnered with Axon since April of 2020, where they basically share information. They share APIs and they share information. And at some point, I think both companies decided they needed to sit down at the table and try to renegotiate this deal. And there was the headline that came out that Axon and Flock are no longer partnering. And then the questions became, oh my God, is this something that's fundamentally problematic for Axon? Is Flock Safety some major competitor? Now, Flock Safety is a little tech startup, right? This is not an Axon-sized company. But I mean, you can imagine all the questions that the headlines like that bring up. So you saw a lot of reaction to the downside in Axon shares. And so I asked Josh about that point blank in the interview. I just said, hey, listen, what's the deal here? Is this a situation where, Axon is deciding they want to go it alone and do their own thing, build their own technology like that? Or is this something where the companies want to continue to work together, but you just need to sort of hammer out a new deal? And he was very clear in the interview that it's the latter, right? They do want to continue working together. They just ultimately are getting down to the negotiating table and trying to figure out better terms, a better sort of working relationship. And so while I think that headline sent a lot of people running for the hills when it happened, I think the earnings report and the call sort of clarified the position there. And this is something it's not some sort of existential threat to Axon's business at all. Like, I mean, he also was very clear, like, if for some reason those two companies can't, figure out a way to make it work, well, I mean, Axon's got a lot of resources and a lot of technology, and they can sort of go their own way with it. And I think another thing to think about too is, I mean, Axon makes little acquisitions here and there, right? They acquired Fusus, which Josh basically, he called Fusus the Switzerland of CCTV. So essentially like this sort of neutral ground where they're able to collect all of this information from the video that flows through the closed caption TV services for any and every customer, public safety, enterprise, and everything in between. They also acquired a little company called Dedrone, which gives them sort of this entry into this drone as a first responder space that's gaining steam as well. So it's entirely possible that Axon could just acquire that technology if they needed to. They have a lot of flexibility financially. And then lastly, I'll just say, like,
for vision is probably like almost table stakes for a lot of companies now, like computer vision and pulling numbers out and things like that. Like it is done in, increasingly small form factors. The AI chips that are built into like, what's the word I'm looking for? Like action cameras and stuff do some pretty incredible things. So
sure,
it seems to me that that's a nut that Axon could crack, in any number of ways by white labeling something, partnering, or just designing their own or having it designed for them. Right.
Yeah.
These kinds of technologies all could be knitted together pretty well.
I think that's right. And, they upped their total addressable market opportunity again. I mean, somewhere in the neighborhood of $130 billion now that they view it. And that is, due to a combination of things. But what they've done a very good job of is expanding beyond like law enforcement, right? I think traditionally we think of Axon, think of Taser, think of police officers, public safety officers. But they're moving far beyond that in the enterprise space. And they noted that this quarter they signed the largest deal in the company's history. And that was with a global logistics provider. Now, I asked Josh to tell me who that customer was, and he said, nope, we're not disclosing that information yet, but we'll find out soon enough. But between the enterprise segment of the business and then the international side of the business, those are the two areas where they're really most excited. And just to kind of quantify that, international today is roughly about a fifth, maybe a quarter of Axon's overall business. They see that flipping to where international ultimately will become about 80% of their overall business. And if you think about it logically, that makes a lot of sense because, like, there's the United States and then there's the rest of the world. Well, which one's bigger, right? It's the rest of the world. And so there's this opportunity for them to continue expanding internationally, and they're doing that. So I just thought that was really encouraging. I understand why they upped their total addressable market, given some of the acquisitions and the stuff that they're doing. But I don't think, there wasn't anything that I was surprised by, but I just think it was a very encouraging report.
It stood out,
particularly given the market's reaction with the stock over the last couple of weeks.
Yeah.
How about you?
As I was watching earnings, one of the things that surprised me, and it was kind of almost, it was sort of ancillary to earnings, but should have been involved until Salesforce reported. And so, we saw results from all of like the hyperscalers who, everything with them right now is about, well, okay, they're making some okay money now. Maybe these ones like Google or whatever, they're still almost all advertising, or Meta. It's all advertising, right? And they're just buying tons of AI accelerators to do stuff with, whether that's train huge models, or do the inferencing, which is when, schlubs like us are using the models later. And 2-3 weeks ago, when they all reported, it was pedal to the metal on the data center spend, which is almost all AI GPUs at this point. And people were still saying, oh, and they must still see really huge demand, so trying to figure out what the end market demand from people like us or from the businesses that we work for in terms of LLM AI is really difficult at this point in time, because a lot of the technology we're being promised doesn't even exist. It exists only in like the minds of Meta's advertising department, right?
What could be?
Because mostly what we see is chatbot type stuff, right? And they're like, oh, we're going to have these AI agents. And every time I rush off to try a new AI agent, it's essentially just a chatbot with some pre-prompting built in. So, it might seem like it's, an entirely different or differently trained AI, but it's really just a pre-prompted chatbot, which I don't think in a lot of cases is a giant productivity gainer. To the extent that there are companies incorporating these things and what I like to think of as the last mile, and especially inside like an enclosed sandbox where they have more control over all of the data that's in that system and other things, I think that they have a much better opportunity to provide services that will sell for decent dollars because they actually increase productivity. And I'm thinking at this point of ServiceNow, which seemed to have a pretty good report this latest earnings season, in my opinion. But then sort of last week, something slipped through, and it didn't. It was covered, but not really with some of the vehemence or I guess didn't get as much coverage as I thought it would, which was when Microsoft CEO Satya Nadella came out and said, "Oh, we're gonna be renting AI compute by 2027 or 2028," and a bunch of us did a double take and said, "Wait a minute, you just said you had insatiable demand and that you were going to spend another like $80 billion next year on this stuff, but within 2 years or 3 years after that you're going to be renting it from other people." That was kind of a big deal and a little bit shocking. Some people maybe didn't kind of believe it, but then there was a couple of pieces of news last week that made me wonder, like, where is the demand going? One of those pieces was when Salesforce came out, and their revenue outlook for the coming year was like 7 to 8% growth. It seemed pretty low, especially because they have been thumping, beating the drum on how much their agent force AI agents are going to just revolutionize the world. And they call them like digital employees and everything. All of this kind of sort of makes me feel a little bit weird. The equivalent, like trying to call something a digital human seems a little dehumanizing to humans to me. But leaving that aside for a second, um, the first thought I had when, several months ago when they said these things are going to be so great, we're going to hire like 4,000 salespeople to sell them. I wasn't trying to be flip, but my first thought was, if they're so great, why aren't they selling themselves kind of already? Why do they need people to sell them? If these are digital people that are so great at sales oriented tasks, why do you need people to sell them? Maybe we got an answer in that revenue forecast, which was, kind of light, and shares responded, uh, uh, as we've seen, it's been dribbling down a little bit. And then the final piece of the puzzle came late last week, or the piece of what could be the puzzle, which was when OpenAI released what was a model that they'd been working on for something like 2 years, if you believe the reports. They're very hush hush about this. And so it's tough to keep all these AI model releases straight these days. Like every other day, there's another one from somebody, and it's tough to keep them straight in your head and what the differences are between them. So I'll go back a little. What are sometimes called foundational models are the super giant models we think of, like Chat GPT 3.5 being kind of the first one. It's the thing where you type in a question and it takes one shot at answering it, right? And those are the models that were getting bigger and bigger because they needed more and more compute and so much data that they actually ran out of data. The idea is that like there isn't enough on the internet to satisfy these anymore. It's probably more like there isn't enough easily available on the internet to satisfy them anymore. And so they actually use data generated by other LLMs to train the future LLMs and so on. But anyway, OpenAI worked on this for a long, long time, spent hundreds of millions of dollars likely. We don't really know the cost. The rumors at the time, rumors in December were that future versions of these things might cost $1 billion to train it before they even deployed it. But when they finally released this last week, they kind of just released it with a thud, or almost, just really on the down low. And they didn't call it GPT 5.0, which it was going to originally supposedly be called. They called it 4.5, and they said like it's not a frontier model. And what that means is, from my point of view, a really big disappointment, because it proved, or didn't prove necessarily, but it is a big piece of evidence that what they were calling scaling laws, that this scaling law doesn't exist. People say, oh, it no longer exists. Well, this law was around so long that I don't think you could say it actually existed. What that means is that they had major diminishing returns. In other words, they spent a ton more money, a ton more compute, and the model got a little bit better than the prior model. But that's actually even overstating its usefulness, because it's not as good as these chain of reasoning models that have been released by OpenAI and others, and DeepSeek being kind of the most famous one, a few weeks or a few months ago. And so this suggests, and OpenAI kind of said, like, we're not going to do this kind of thing anymore. We're done spending, 2 years trying to build these giant models that don't really do any better than the systems we've got now. And so it suggests that we're kind of, for now, a little bit at peak LLM in terms of trying to get one singular computer brain that can answer all these questions. And all of that goes towards trying to figure out, like, what is the future demand for all of this LLM AI that is out there, and what is the market going to look like going forward? And I don't have, definitive answers right now, but I just think that although these stories were reported, I don't think the dots were connected between all of them all the time. And it's an interesting case of a potential bear case sort of hiding in plain sight that maybe isn't fully appreciated.
No, I think there's a lot to be said for that. I mean, I think you posted an article in our investing team Slack last week, and it was a TechCrunch article, I think, but it was the article that spoke to what you were just talking about there, in particular, like in regard to the scaling laws. And I think those are really good questions to ask, because I enjoy fiddling around with these models. I mean, I've got the Gemini app on my phone. I fiddled around with Grok on my phone, and use Chat GPT and all that stuff. And I mean, they're all fine. Like they're very helpful tools, but I do find that as time goes on, they are all basically kind of just becoming the same thing,
Mhm.
and there is a limit, right, into exactly what we can really extract, like what we can do with it. Like it's sort of that difference between, oh, this is novel technology, it's fun to use, and then we got to go to, all right, but now how is it really changing my life as a person? So I mean, there can
To
certainly
the
be
point
use
where you
cases.
or your employer might pay money for it,
Well,
and
yeah,
and a
and
lot of
and that's
money.
just it. It's like, I mean, I definitely would not be paying any money for any of those subscriptions. We saw Amazon just announced this past week this sort of upgrade to Alexa, where they've got Alexa AI, and they're going to offer a subscription for $20 a month. But hey, Seth, don't worry. If you're a Prime member, you get it for free. But again, having tinkered around with Alexas for years, I find it to be not really that terribly helpful. I mean, it's a great kitchen timer, like when I'm cooking, pasta or something. But and I mean, I know I've told you before, I hooked it up to the lights and I got it in the house. Alexa, turn on the lights, and it was great. It worked until it didn't. And
Yeah.
then when it didn't,
What
it was
about
like, all right, turn on and so it didn't work. So you know what? The light switch. The light switch is undefeated.
they
But
work
yeah,
pretty
I
well.
do feel like the diminishing returns comment that you made there, I think really stands out to me because I'm not saying we're there, but golly, it sure feels like we might be at a little bit of a lull in the
Yeah.
development of this
And
technology.
and I think what matters at this point is something that others have pointed out, so I'm just sort of standing on the shoulders of smart people instead of standing on the shoulders of giants. Standing on the shoulders of smart people is that it's very unusual, for the value in these kinds of situations not to accrue to, like, specialized software providers at a certain point. In other words, like, hardware providers are making all the money right now, and then, like, the cloud outfits, but it should be the software businesses that are doing best, and they should be doing best because they should be incorporating this stuff, like, where it matters the most, right? Like, an internet was really cool, but an internet didn't really, help many of us until a bunch of smart people figured out ways to make it useful, right? It was in the beginning just a way to like share papers between
Yeah,
scientists and information, right? And so this is why the CR or the Salesforce thing was a little weird. I would have thought I was a little surprised there. I thought they were going to do better and have a better outlook because my sense was that because they have kind of a closed ecosystem, it's sort of their sandbox, that they should be able to do a better job of delivering like a more autonomous and more productive suite of agents. And when I say agents, I mean I'm hoping to mean autonomous AI agents that kind of do things on their own, not just mostly chatbots. But part of what has surprised me about LLMs recently and over the past few months is how well the chain of thought reasoning, quote unquote, I don't actually think it's reasoning, but it sure simulates it pretty well. How well it works at a lot of times, how it's become free and how it's already delivered even for free at, in the last mile or at the point where you'd want to use it. One of the examples, that's a main example, is like in the IDEs or in the programming tools that you would use to do programming for apps or websites or whatever. Like you can right now, I've got it on my machine over there. I've been doing a little more programming lately because the AI tools have made it easy for me to go back and take prior programming where I wrote thousands of lines of code by hand and actually kind of resurrect some of that on new platforms that are current so that I could use this stuff or share it with other people who want to use it. I do things like running calculators and stuff that aren't all that common. Um, and right now, like I can already get in a free IDE, Visual Studio, for instance, I can get Copilot for free with no subscription, which will let me use one of three different models that I want. I can use one from Anthropic, I can use one from Google, being Gemini, or I can use OpenAI's Chat GPT 3.0, I think, or 3.0, so lowercase o. All of it's free. Like all of that is free. Now there are usage limits at some point, but I'm never going to hit them. And I think a
yeah,
lot of developers aren't going to hit them. Enterprises will hit them and start paying the per token or the per million token fees, but like general users may never hit those. And if you go, to some of the websites, like what's kind of funny to me is that OpenAI or Anthropic have been releasing tools that are only available to their expensive monthly subscribers. But, Google with something like AI Studio has released tools that are, almost as good. What happens is just about every time someone releases a tool, it's usually the best one because it's the newest. Um, so they all have a lead for a little while, but Google and others are releasing these things, for free. And so that really makes you wonder, like, where's the revenue coming from? I don't know the answers to that. I don't think it's revenue less. The people making these decisions aren't idiots. They got to run the machines, and they have to be making it up somewhere. They think they're going to. But the economics of this entire revolution are really still in a complete state of flux right now, I
Oh,
think.
for sure. For sure. Yeah, and I mean it's going to be it's going to be something we have to watch play out. I mean, those Microsoft comments like you mentioned were a bit odd, and then you hear what Andy Jassy, right, the CEO of Amazon, said this past week, that there are not enough chips and servers to satisfy the AI demand.
Yeah,
Um,
right now.
who knows? I mean, I know that this doesn't just grow to the sky, right? At some point, things start to level off. When that is anyone's real guess. But yeah, it does feel like the as amazing as the technology is in the potential that we see in it, certainly the economics of it for investors remain very unclear right
Yeah,
now.
and one of the problems, quote unquote, is that the hardware makers as well as the model makers are getting so good at what they're doing. So you get this, the one side you have like this incredible increase in demand. And I don't think we actually know what that is. Nobody has really told us what it is. So it's really hard to gauge. But the other side coming down the other way, or however I'm going, is that like what Satya Nadella said in Microsoft's call. He said something along the lines of, we get like a 20 times, if you count the boost they get from better hardware and the boost they get from optimizing the models to do things more efficiently, they get basically, I don't know, there's a weird way, but they all say it this way, they get 20 times the compute out of this stuff every year. They get like a 20 times increase, which is a weird way of putting it, but to me that means that it costs them 0.5%, or whatever that is. If you work it backwards, it costs them that much less um, to get the same amount of compute out. So in other words, and then, NVIDIA
Yeah.
says like our new stuff is going to be so much better that those numbers are even different. So at this point, you're trying to plot, like, if you step back, you're trying to plot what some are claiming is an exponential demand curve, because you have people saying, well, we're going to use all these chain of reasoning prompts, which do, 15 or 100 times as much prompt chewing as a single prompt used to. So you're trying to plot a demand curve that may or may not be like really steep or exponential against a compute and optimization curve that's also that way. And so I think the shortcut for me was when Satya said we're going to be renting by 2027, 2028, because I assumed that he has better models for trying to understand this than we do, looking from the outside in.
That would be my assumption too. I think that's a safe assumption. He knows more than we do.
Very probably about all of it. We got some questions from Jimbo. Deckers, outdoors, on Cloud, and Nike. Can Deckers go more apparel a la Lulu or Under Armour? Hopefully, if it does, it looks more like Lulu than Under Armour. Well, if you had held Under Armour at the right point in time, you would, and got out at the right time, like most of us didn't. You might put that differently. I'm going to field this one a little bit because I'm a running shoe nerd.
Sure.
So Lululemon started with apparel and remains apparel. Under Armour started with apparel and was primarily apparel. I don't know if Lululemon's doing shoes right now. I haven't kept up with them. Again, I own it, so I don't watch it very closely, or I owned it until recently. I can't remember if I sold it or not. And and Under Armour went into shoes later, and that's a lower margin business, and they did okay at first, but then it didn't help them out. Can Decker go more into apparel? So Decker has been doing the apparel thing for quite a while, as far as I remember, back when they were doing with UGG and others. And all the athletic shoe companies now do a lot more apparel than they used to a few years ago, to the point where it's almost ridiculous. Like if I go online, my daughter is a pretty good track runner and I'm a distance runner. So when I go to buy shoes, like I'm there for shoes. And when I go to buy her track spikes, I'm there for track spikes. And what's weird is that these websites are not sophisticated enough. So they're always like, complete the look. And I'm like, complete the look for a pair of running shoes that I'm going to wear in the summer for a 20-mile run on the trail. You know what the look is at the end? And for a 20-mile run on a trail, the look is my crummiest old t-shirt, a pair of shorts that hopefully don't chafe me to death, and I look like a zombie at the end. Like that's the look. But they're all trying to push apparel because it's a way to try to add on to the sales, right? So I don't know what the success will be, and I honestly don't know about the success with On Cloud. If you're new to this situation out there, Deckers had a very good quarter. Or not they had a what looked like a decent quarter to me. Stock dropped. I can't remember what On Cloud's latest results look like. Probably fabulous again. Nike has been on the ropes for months now, because of some sins they did not correct coming out of the kind of COVID stay-at-home time, in which they kind of got rid of their physical retailer partners, tried to do everything online, and figured out that's not working so great. If I had to rate these, if I had to put these three in order, which ones I'd like to own, honestly, I think I'd go Deckers, Nike, On Cloud, and people are screaming at me because On Cloud is the more popular one at the time. But I've been a runner for so long. I've seen so many running shoe fads come and go. And honestly, when I go out, like I see On Cloud I see those when I go to the orthodontist or I go to my ophthalmologist, and I see on the running trail, I see so many Hokas, which is Deckers Outdoor. I see so many. The other day I saw like 8 out of 10 pairs. I couldn't believe it. Were not only Hokas, they were Bondi. They were one model of Hoka shoe, which was my favorite one, but I've actually probably will quit wearing them because they wear out too soon for me. And then a lot of Nike. Nike still has a brand and they still have really good tech. So they can fix this problem. Will they fix it is a question, but they can. But that's how I would rate those three. Just because, one of them's more expensive than the others and looks more fatty to me, and that would be the On Cloud. But I always miss those, so maybe you want to do the opposite of what I think.
Yeah, I think Nike might be the stock I most recently bought. I added it to my retirement portfolio primarily for the dividend, but I also feel like the shares represent a lot of pessimism today for good reasons. I think you stated it just right there. They made some bets a few years back, focusing more on the direct to consumer and the Nike digital, and sort of foregoing their wholesale channel and partners. And those chickens eventually came home to roost, and they realized, we probably shouldn't have done that. And so, yes, it's a fixable problem. Whether they actually execute and fix it, that's another question entirely. Obviously, a company under new leadership. But yeah, there is a lot to be said for Nike's brand equity. I mean, that really does carry it a long way. But yeah, I would view them as very different styles of investments too, right? I mean, I don't know that you're necessarily looking at Nike as some, massive growth story. I mean, there's going to be growth there, and hopefully, if they are able to sort of right the ship, then the valuation would make it look even better as far as a growth story goes. But yeah, I have a hard time looking at Nike and thinking, what, their best days are behind them, because like you said, they have a lot of tech, they have a lot of capital, a lot of resources, and it just boils down to making sure you have the right leadership in place to strategically take the business where it needs to go.
Yeah. Folio says, Seth, completing the look with my shoes is the anti-nipple chafing balm in a post long run Gatorade. Yeah, I would say, yeah, those are good. I go with tape, actually, tape on that spot. And instead of the Gatorade after the run, if I have it, you know what I think is important? The protein shake of some kind. Your
Right.
legs are so beat up. The research supposedly suggests that if you get your protein soon, your legs are happier because you beat the heck out of them. But Jason, do you have an update on IoT?
Yeah, that's a good one.
Jimbo had that question.
IoT is Samsara, and I mean, I don't have an update right now. I mean, the company reports earnings on March 6th, so I'll have an update shortly after that. But I mean, I think generally speaking, the thesis still remains, right? I mean, they have this this connected operations cloud that ultimately helps enterprise customers connect all of their devices within their sort of existence, right? I mean, think about buildings and all of the things that go on in those buildings. You think about cars, I think, and telematics. Samsara does a good job of making all of those devices connect and talk to each other, get data. And the value proposition for companies. I mean, one obvious example in having these telematics, right? These cars that transmit all of this data, they are able to reduce accident frequency. They're able to reduce any types of traffic incidents that ultimately saves lives. It saves a lot on their insurance policies. And that's just one example. But I mean, that'll be one I'm going to, definitely be looking at here when they report on March 6th. But I mean, I think for me, it seems like the leadership continues to do what they say they're going to do, and they continue to lob up these really impressive growth rates. I think if anything, when I look at a company like that, I think, all right, what's the downside here? What's the risk? I mean, the valuation is obviously out of the conversation, right? This is a company that's still finding its way towards profitability. So this is definitely a valuation where that probably is one of the bigger risks for investing in a company like this today. Now, thankfully, we recommended it in Next Gen Super Cycle back at like $16 a share, so it was not as big of a risk at that point. But they're guiding what looks like here for fiscal 25 with revenue growth of 32%, and actually adjusted revenue growth of 35%. So I think if or when we see those growth rates start to slow down a little bit, and I mean that'll happen eventually. We want to see how the market reacts to it, right? We want to see how the market treats this company, because it's come a long way in a short period of time. But we'll definitely be keeping up with the earnings on March 6th, so I'll have more. I'll have more then.
And there's one up here, which is was it? It was Jimbo again on GARPs, and I'm not sure if Jimbo, if you were the one who asked. I actually brought up Deckers last time I was on as an example of what looked like a decent GARP. But to stay kind of in that same realm, I just sort of was like, what comes off to the top of my mind? I was hoping Dick's Sporting Goods to stay in kind of the same zone would look that way. It looks a little bit more pricey, but it comes to mind again as I was thinking about shoes and apparel. With a kid who is doing a lot of running, wrecking clothes, going through shoes and stuff. We go down there, and it's not a store I used to frequent a lot. And we're always just kind of impressed with the value Dick's has. Decent sales. They keep you coming back. They have a good selection of sporting goods. My wife bought some golf clubs there. She's a beginner golfer. She was able to get, perfectly serviceable set of clubs at a reasonable price. We get, some of the running shoes there, the running apparel, and their house branded gear is pretty solid at really good prices. And they just kind of impress me as a company that serves that market well. And that is not always my impression of kind of the mid-range sporting goods company. One of my favorite chains, a smaller chain, shoe chain, like changed out They used to make what I thought was the best apparel available for running, better than like Nike or anybody's. And they kind of changed it out to somebody else, and it's just not as good anymore. And it kind of costs the same as the name brand stuff. Whereas like we go to Dick's, if we buy some shorts and shirts and stuff, I feel like they're less expensive than the name brand stuff, and they are nearly, if not at the same quality level. And so I was hoping Dick's would look a little bit cheaper, but as I run through the numbers here, it's trading for like a 3.3% cash flow yield. That would be 4.7% if we kind of looked at their typical free cash flow margins and applied it to the last 12 months sales. So not bad. They tend to earn a return on invested capital of about 5.6% better than their weighted average cost of capital. Trading at a kind of a, the price to earnings right now is 16. It has, tended to be over the past years, maybe in the 10 to 11 range. So looking a little pricier, but, margins are kind of like gross margins are up in the 35, 36% range. Whereas like in 2020, 2018, they were below 30%. So maybe we've stepped up and we need to, be paying higher multiples. The sales growth is consistent. It's not enormous. What do we got here? It's like, in the neighborhood of like 7.6% a year or something recently. Maybe not as quite as much over the last couple of years. I would keep an eye on them. It looks somewhat reasonable, and it's the kind of stock that might get more reasonable if we had like a little consumer spending pullback. And I think it's just a solid business that it seems really well run to me. As I look at the financials and as I go there and throw my money across the counter.
Yeah, I think I'd probably one that stands out to me. I feel like this has been a bit of an overreaction is in the trade desk. I mean that reaction to that quarter. I mean, that stock has pretty much been cut in half at this point, and maybe not fully, but close. And I mean, I understand for a company that has continued to exceed their own expectations quarter in and quarter out, right? I mean, I think it was something like, did they say it was 33 quarters? It was the first time in 33 quarters that they actually missed their own guidance. And there's some issues there internally that have them a little bit on the defensive. It seems like they're doing some restructuring in regard to leadership, doing some restructuring in regard to their go-to-market strategy. In continuing to invest in the business. But this is a very well-established business with technology that a lot of big customers use, right? I mean, Netflix, Disney stand out as two very, very core customers there that really find a lot of value in the programmatic advertising market. And it's not to say it's a market without competition. I mean, there's plenty of it. But I the trade desk is going to continue to grow. And for a company that's already producing free cash flow, even after accounting for stock-based compensation, I mean, they actually make money in playing in such a large market opportunity there in advertising, the growth of connected television and their role in that with those established customers. I have a hard time looking at the trade desk today and thinking that investors buying shares of Trade Desk today, and I'm not telling you to do that, right? This is not personalized financial advice, but I'm just giving you an opinion here. I think the price today, 5 years from now, I think investors would look at that and say, wow, that worked out very well.
Yeah. I have to look again. I forget what I own and what I don't own. A month or two ago, or over the past few months, I'm getting older, and so I have been selling stocks that looked fairly richly valued, and that maybe I didn't follow as much, and that I just couldn't see the upside. Not necessarily because I couldn't see the upside, but because I was just like, it's just I see more risk than reward, and I think the trade desk is one of them, which I think I got lucky. Now I look at it and I'm like, ooh, maybe I can get to buy back. I did that once very famously with Chipotle way back when
Yeah.
I like wrote it up to a high, and I was like, yeah, it looks a little bit rich. And I sold almost all of it. And then, or maybe I sold all of it, and then it like crashed, and I was able to take what I had gotten and roll it back in. And then it took off again. but this is luck rather than strategy. But yeah, the trade desk, like if you look at their price to sales ratio, which is a shorthand I like to use, but it's only in kind of context of if the price to sales ratio is going up, but like not a lot else about the business is doing a ton better, I start to wonder. Conversely, if the price to sales or the EV to sales ratio goes way down and the company's numbers still look good, then I figure that maybe the reaction is something else. And in the case of the trade desk, I mean, right now it's trading at like 13 times revenues, which is, it almost never does that. It did that in 2023, did that back in 2019 or 20. And then before that, it was 2019. And I always then look at like a chart of margins to see like, or first of all, the revenue chart to see. And the revenue chart for the trade desk, actually, that line does this, and it's steeper-ish now than over the past 5 years than it was in the prior 5 years. So not only are the revenues higher, it was growing a little more quickly, and the margins, the gross margins are solid, again, higher the past 5 years than they were the prior 5 years. Ditto like free cash flow margin. Operating margins actually kind of down and moving back. So I'd probably want to dig in and look at the numbers a little more carefully there. But it is hard to, if I just compare my charts, it's hard to reconcile what happened to the price at the end of this chart, toward the recent end of the chart, with what happens to the financial results at the end of the same charts. So that's always
a big reaction,
potential opportunity. Yeah.
Very, very big reaction. So yeah, I mean, it's certainly one that I've got on my radar, I would say. And I mean, I own it already. Like I've owned it for many, many years. So whenever I see something like that, I'm like, is that an opportunity? But you talk about growth at a reasonable price. I would say in regard to trade desk in the context of its historical valuations, I think this is a pretty reasonable price for a company that's going to continue to grow double digits for a long time to come.
Yeah.
And not all these software companies can say that anymore, right, Seth? I mean, you were just hitting on Salesforce there earlier, and that Salesforce I'm always kind of torn on. Like I don't own it personally. I recommend it as one of the services. It almost feels like they are going to need to start relying on acquisitions more. And they've made a lot of acquisitions through the years, right? A lot of that growth, the scale, the size that they have has come through acquisitions. And I think most of it worked out pretty well. But you have to ask yourself, like, is that sort of the way this company is going to grow? And if so, is that the kind of company that I want to own? Right. I mean, you've got organic growth companies. The companies are just growing on their own by virtue of what they bring to the table. And you have companies that grow inorganically, right, or non-organic growth. And those are just companies that continue to make little acquisitions here and there to continue expanding their share of the pie. And Salesforce, I mean, in the early days, plenty of organic growth. I would say the last several years, we've seen a lot of acquisitions in order to kind of get this business to the next level. And you start to wonder, like, at what point will they be able to kind of re-accelerate that, right? I mean, if a company like Salesforce is growing at 6, 7, 8% a year, that just doesn't sound really compelling. But we also are living in an age where a lot of these enterprise software providers, I mean, they're saying the same things on all these calls. They're like, man, every company, every customer out there is spending every dollar frugally. I mean, they're watching every penny going out, and so we're not out of that stretch where companies are spending so freely, and that impacts a lot of these software service providers. From Trade Desk to Twilio to Salesforce and beyond.
Yeah. And Salesforce, to pick on them, but not to pick on them, but to pick on them. So, we talk about the cash flow. Again, I got my little spreadsheet behind me here and I can look at it. Free cash flow yield currently is 4.4%. I calculate free cash flow a few different ways. But so I'll give you an example. Trailing 12 months, or actually, I guess it's fiscal year. It's just ended here in January. If my charts are all right here, we're looking at 37.9 billion in revenue. And what do we got for free cash flow? If you do it this way, you get 12 billion and a $282 billion company. You get a free cash flow yield of like 4.4%. But then you have to ask yourself, like, what's in the free cash flow? And for a lot of these companies, you might want to look and say, like, what are they doing with that cash? And the answer in a lot of cases is buying back a ton of shares. Now, we always used to like to say that, share buybacks are very shareholder friendly, and they can be, but you want to look at the share count, right? And in the case of Salesforce, like, the share count is, okay, the 10-year compound annual growth rate from 10 years ago to today is 4.6% a year toward getting higher, right? 5 years, 2.8%. It's dribbled down a little bit over the past couple of years. So the buybacks, if they're doing them here, have maybe been helping, although diluted share counts are also, affected by like which way the stock price is moving things too. But my point is that if you look at their free cash flow calculated sort of classically, it's like 12 billion in the last year. But if you subtract everything they spent on stock buybacks, which haven't moved the share count a ton, I would argue, then that free cash flow comes out to 4.6 billion. So you went from, so you basically went down, almost to a third is maybe the free cash flow that's left behind for outside investors, and the rest of it looks a little bit more like it was compensation because it's being used to soak up the share dilution. And that some people might think that's picky. Some people might quibble and say, okay, the methodology there is really wrong. You need to unfetter it a different way with a more complex calculation. However you want to do it, once you get down to the kind of 7 to 8% top line growth phase of these companies, you want to pay a little more attention to those kinds of things. Because if companies that are growing that top line at like 20, 30% a year or more, some of those sins will be washed away just by the sheer growth, right? And you don't want to worry too much about what's happening there. But once they start to slow down, you might want to pay a little more attention to that and the valuation, because it may start to matter more eventually to the market. The market eventually tries to price companies rationally most of the time.
Yes, it does. Well, we are up on the 1 o'clock hour, Seth. I think that means we are getting ready to hand it off here to, Andy. It looks like, Andy Cross and Jason Hall.
Jason.
I've got good news. Okay, we have tested whether it would break the space-time continuum if there were 3 Jasons on the live stream.
Look at that.
And we're good.
I'm always the odd man out.
Andy's the odd guy out.
Just always the odd man out.
One of these things.
Maybe your middle name could be Jason.
One of these things is not like the other. Exactly. In many ways.
Love it.
Starting
That's
with
so good.
Yeah, so you guys can get more into the intricacies of free cash flow and valuation and trade desks and everything else.
Thanks, fellas. Awesome.
All right, Seth, Jason, see you guys around. AC, how are you, Andy?
Hi, Jason. Great to see you. Welcome, Fools.
You too. Hey, Fools. All right, let's kick this thing off with our initial stuff. First of all, under the radar underperformer. That's going to be our theme for this hour. And I'm really excited about this one, Andy, because what I'm going to do is as we get into this, I'll toss out a couple of examples of stocks in my portfolio. And I want you to weigh in with me and tell me, what do you think? And I want Fools.
Great.
Yeah, it's a great starting point, right? And maybe that'll encourage Fools out there in our Slido.com, event code Fool24. Throw out some stocks that are compelling to you, that seem like maybe these are under the radar opportunities. And we're going to weigh in whether we think they're under the radar opportunities or maybe just underperformers. So that's going to be a lot of fun. As always, remember, there's a lot of smart fools that show up on this side of the camera, but we don't know you. We don't know your situation. We are not here to provide personalized or individual financial advice. Take everything we say with a grain of salt and then do your own due diligence and own your own decisions. Andy, what do you think, buddy?
That sounds great. Sounds awesome. Yes. Thank you for that. We love talking stocks. We just can't give personalized financial advice. Consider this informational purposes only.
Yeah, absolutely. Okay, so I see, Fools, we got some questions that are already coming in, but I want to kick it off with the idea. I'm going to throw one out there that this is an interesting, and Andy, this, I don't know that you really know much about this business, but I love the idea of talking about it here. I'm going to throw out a company called QuantumScape. Okay, so QuantumScape, for those that don't know, is a startup. It's still a startup. They're focusing on solid state battery technology. So this transition to the electrification of everything, one of the big limiters, particularly for cars, but even for like smartphones and watches and other things, is the weight of batteries, how quickly they can be recharged. The standard technology that we have with the gel and liquid based battery, lithium ion batteries that we know about now, has a lot of limitations. Solid state batteries would make for lighter cars. You can go more range at the same weight, like all of these things. QuantumScape, again, a lot of people haven't heard of this business. It is a
Jace, you got a ticker for us?
Yeah, QS. QS is the ticker. Here's why I think it is under the radar. If you look at the stock, it has been a terrible underperformer so far since it went public. Went public back in 2020, I believe, late 2020, which was a great time to go public. Great time to raise capital. But again, they're so far still a zero revenue business. The reason I think it's under the radar is if you look at their ability, thinking about it like a biotech, an early stage biotech, to reach many of their goals along the way of advancing the technology, getting samples out to automotive OEMs for testing, start some pre-commercial manufacturing for test samples, and now the joint venture they have in place with Volkswagen, where Volkswagen they're going to begin commercial manufacturing in the second half of 2025. I see a business that's primed to be an under the radar winner.
Jason, this is a $2 billion business, right?
Looks like, with $0 in revenue.
So it is, I was just thinking about when you said quantum, I thought you were going into quantum computing because there's been a lot of excitement around that over the last year. And you see a lot of the companies in the same way. So, when you think about these pre-revenue companies are still trying to find their business model, it's like, how do you think about valuing these companies? A lot rides, I imagine, on leadership. I think Quantum got a new CEO last year. QuantumScape did. So, so, there's a lot of ones that are like, this is a lot of exciting tech or exciting market opportunity, and they got to get a business that can be able to deliver that ultimately.
Right. Absolutely. That's exactly right. And it's interesting. So thinking about maybe the mindset of looking at these sorts of businesses to try to find winners, when you see changes in leadership, there's reason to start asking the hard questions, particularly of yourself. If you own stocks like this, what's going on that the existing leadership was not able to move the idea forward, or are the leadership changes part of the process, right? Of moving from idea creation, development to operations, right? So I love like those ideas of being able to think through these ideas to try to get past whatever your inclination is for a stock. Because if there's any one stock that is like the ideal stock for you to be able to convince yourself whatever you want to believe, it's a pre-commercial story stock.
Yep. I mean, they have 900 million of cash on the balance sheet, 910 million in cash on the balance sheet. Right. They're losing money, pre-revenue, obviously. So trying to figure out what that real model is. New CEO came on board. In, like you said, in a technology that, has the promise, but, thinking about, hey, is this I don't even like the term speculative, and I've used it before. I don't really like it.
No, I think that's fair.
I think it feels speculative, even for companies like this. It feels more gambling.
Yeah, right. No, exactly. Right.
So anyway, but you got to think about position sizing and risk mitigation with something like this.
I think that's exactly right. And so for me, I talked a little bit about seeing them reach their goals with the technology and with their A samples to their beast, like all of these things that they laid out and their ability to execute on those goals as being good. And then taking that and building on Well, do they have the right people in place?
Yeah.
They're the person that they just named CEO last year. They brought him in as a president a few quarters before that. Is somebody with a background in precision manufacturing, in his case, in the semiconductor industry. So going from the founder, who was the CEO, who was an academic, that brought that developed the technology in a lab in a university, I believe Stanford, and now going through the process of taking that into a private company, getting VC funding, then taking the company public, and now starting to run into those real challenges. How do we commercialize?
Yeah.
And the company making the decision, we need leaders that can lead that commercialization, which brings us to where we are. And it's one of those things where my cadence of following this business says the risk factors have come lower, but we still have a certain level of probability of permanent capital losses, like the measure of risk. It's still there because the company has yet to manufacture and sell its product at a commercial basis. So that's where risk lives, right? And when, again, you thinking about the term speculative, whenever there's a high degree of probability of permanent capital losses, I think speculative still fits, because with other companies that you might throw the term gambling around, where it doesn't apply is if you just have a long enough holding period, the company's business should be the thing that allow you to make money at some point, even if there's a period where, you're on paper, your value is your value, it's underwater, right? When a business isn't selling anything at all, you can't hold long enough if the stock has a chance of going to zero or close to it. So that's a risk there. Andy, you're doing some weird stuff on the screen here. So
I'm a little frozen. Can you hear me?
I just heard you just now. Yeah, I heard you now.
So I'm a little I'm frozen here, so I'm just kind of trying to get my camera all set. But thanks for that explanation on those. So I'm just gonna, you keep going. I'm gonna just get my camera set here and then come right back.
No, that's good. I think so. So I think that's about all I want to say about, again, that example with QuantumScape. But just here's another example I want to throw out there. So Bank of NT Butterfield and Son, the ticker there is NTB. Not a lot of people know about Bank of NT Butterfield and Son. This is a bank that's focused. Its retail operations are Bermuda, Cayman Islands, Channel Islands. So places where there's lots of international money coming through, high net wealth banking elites. It's a high touch, high service based business. You're not going to see one in Main Street USA anywhere. Again, they're very targeted in where they operate. The idea when I bought this stock, and I've owned shares for a long time, and it was actually bought in some of the early real money portfolios at the Motley Fool, and the stock really hasn't performed very well at all. The business hasn't grown very much. It's grown earnings at a modest amount. But the stock hasn't delivered big long-term returns. And this is one where I'm going to have to really sit down myself and go through this exact exercise. Where is this an under the radar stock that has potential to deliver outsized returns, or is it just likely to be an underperformer because of the mechanics of where it operates, that core business, and minimal ability to grow earnings per share at a rate that can lead to it being a market outperforming business. Now, as a starting point too, with a business like this, the dividend yield is well over 4%. So you're already almost halfway to matching the market's returns. So the fair valuation for a business like NT Butterfield, if you can get 7 or 8% a year in earnings per share growth, welcome back, Andy. If you can get that 7 to 8% a year in earnings per share growth, bolt that onto a 4 or 5% dividend yield, and all of a sudden you're above the market's long-term, 10% per year average returns. So again, I have to put NT Butterfield through that ringer of determining, because in my ownership, it's been an underperformer, right?
Yeah.
And we know, Andy, typically businesses their stocks tend to continue doing what they've done. It's very rare to buy a business that's been a laggard for a period of time and expect it without some catalyst to turn into a winner.
Yeah, and NTB has just been a little dividend nice yielder over the last few years. Stocks up a little bit. It's had a nice run the past year or so, but
it has.
Nice
every bank has, right? Every bank's done well over the past year and a half.
So the banks have done well, and you get a little bit of yield with NTB, and I hadn't even seen. It's probably about a $2 billion business, right? I'm guessing, about a 1.5, 1.6. Yeah, 1.6 looks like 1.6 or 1.7 billion, right?
You say so. I'll trust you. I'm looking it up now because
I think that's what it is.
Yeah, 1.7 billion. No, okay.
1.7. Yep.
Okay. Yeah.
Yep. Sorry about the audio and visual challenges.
I'm glad you're back. You look great, by the way. You look fantastic. So,
Thank you.
Absolutely.
Thank you. Jimbo had asked about MedPace. Just very quickly, I'll hit on that, which has been a great performer over the last few years, but it's really struggled. And Jimbo, I didn't rank it highly on a recent ranking that I did for the Backstage portfolio, just because their clients, which they serve, as you mentioned about some of the small biotech companies, they're some of their expectations for future spend on some of the research that MedPace does for their trials is looking challenged right now. We've seen this time and time before with MedPace, and that team tends to be able to execute through that. But they have that. They had a few, I think, some operational challenges. So it wasn't one that I was pounding the table on, even though the valuation, the stock went from 150 over the last couple of years to more than 400. Now it's pulled back down to the low 300s. So it had done really well with the expectation because they had been executing so well. I think some near-term challenges, I kind of expect those to persist. A lot of those tied to the funding environment, the interest rate environment that had been elevated for a little bit longer, Jason. So I think that's probably going to persist. So it wasn't one that I was pounding on buying, but I think certainly they're pretty well run, and I think that entire market is seeing some challenges, and those are more cyclical, I guess, tied to the funding situation. I'm not saying interest rates are going down anytime soon, but if that normalizes over the next couple of years, then we'll see some funding come back into the space, and that will do well for MedPace. By the way, that ticker is MEDP. MEDP.
Right. Yeah. Right. So Ed asked a question. I like this question, and we have some good under the radar underperformers that have coming in. So we're going to get to let it ride. We're definitely going to talk about Toro Company. But Ed asked, which companies are giving too much stock-based compensation where the shareholders will eventually pay the price? I want to answer this question, but I wanted to ask this question and talk about it because a lot of time stocks that are absolutely not below the radar, very visible companies, the tech darlings particularly, the under the radar weight on the growth of earnings per share, the thing that most investors don't know about or think about or talk about is exactly this, stock-based compensation, where it can really, really weigh on the returns. So Ed's question, again, which companies are giving too much stock-based compensation where the shareholders will eventually pay the price? So there's a company right now that you go first, Andy. I have one. I can see you have something lined up to say.
I'm sorry. I didn't mean to interrupt, but yes, I was just like, yes. Because we have talked a lot about this recently because it's starting to, when money's free, the more willingness, I think, for the market to look past this. But when money is not free as it is now, you start to say, listen, that stock-based compensation has a real cost. It is an expense that is on the income statement, but then it gets added back to the cash flow statement and added back into a lot of free cash flow calculations because it's a non-cash charge, Jason.
Right.
But it's real. It's an expense because we have to pay for that. And ultimately what happens is the company tends to issue stock to help pay for those shares.
Right. If a company is growing earnings per share 10% a year, or if they're growing earnings, net income 10% a year, and they're issuing 2% a year in additional equity, and they're not doing anything about it, earnings per share is 8% a year.
And then you see a lot of companies that will go and buy back stock to help try to offset some of that dilution. So they're using shareholder capital
There you go.
basically
There
to
goes.
help pay the
That's right.
employees.
That's right. There goes your cash flow, and that's where eventually it comes back to affect shareholders. Now, I want to say this before I absolutely lay into the company that I'm just so heartbroken about when it comes to this particular thing. Stock-based compensation is not evil. It's important. It's how these companies develop and retain top talent. It's also how so many of these companies get that best talent before they go public, right? So the issue is when it continues in large amounts after the companies are now publicly traded. And the one that just breaks my heart, and I think this is really, really weighing on the value and the potential value, Andy, is Zoom.
Yeah.
So we know Zoom's business is challenged. We know Zoom, the product, they've done some innovation, but at this point, I think they're really almost swimming upstream against a slow current, but they're having to swim upstream because there's a highly competitive environment that's weighing on their margins, and they're churning a lot of even their biggest customers. If the metrics they're reporting, they're going to stop reporting enterprise customers, like the customer count. They're going to stop. That's very telling to me that they're going to not even report that coming soon. That they're having to really churn that customer base to stay ahead. It's becoming more concentrated in the customers that have built on that platform that are staying on it. And this is, and they've got this massive pile of money that they've yet to be able to leverage to find another leg of growth. Right.
Yeah. I mean, massive, like $7 billion for a $20-ish billion company.
Massive amount of money. And I love the discipline, right? But it concerns me that the company is not willing to take risk with any of that capital, right? And Andy, they touted $15 billion in stock buybacks in fiscal 2024, and they added 7 million shares in net increase in their stock and their share count.
Yeah, let's just see what they're, just very quickly as you're talking, what is their stock? So their stock compensation is almost about $1 billion, about $1 billion a year.
Yeah. Yeah. It is substantial. It is substantial.
Right. So their share count, their share count, as you look through, as I'm just glancing through here at their cash flow statement over the last 5 years has gone from about 280 million to 306 million. And last year
it was around 300 million at the beginning of the year.
So up slightly. And last year they had, and over the last year, essentially, last year they bought $1.1 billion back in stock.
Their
share count went up.
And the share count went up. The share count went up, right?
Yeah.
That to me is a failure to create value.
Yeah. Well, yeah. And the challenge, as you mentioned, Jason, they're growing right now. Their revenues, they're very profitable. You know, even if you keep that stock compensation as a part of as free cash flow, meaning it's subtracted, you don't add it back, you keep it. It still generates a lot of free cash flow and a very good, healthy yield and on their investment, but they're only growing 3% a year. And that gets to your opening point, which is it's just very hard. We've said this over the last few months. It's just that Zoom has become this value company where they're trying to figure out how they can operate in a very competitive space.
Yeah.
Without something that's going to be able to propel them into the next stage. And I own the stock and it's down a lot for me. It's been a little more better recent performer, but that's a little bit of salt in the wound because it had performed so well. And then of course it didn't as the market really shifted, and it's going to be hard for them to, I think, to break out of it. Now the stock's not all that expensive, but you do say that they can generate a lot of return on their investments. But right now, a lot of those investments are going into stock comp.
And I think to a certain extent, investors are starting to maybe view it as this under the radar, because it is one of the fallen darlings of the post-COVID era, and it trades for 13 times free cash flow. So I mean, that's a saving grace. If anybody that's invested in the stock over the past year and a half, really, the saving grace is that you bought it cheap and it's still pretty cheap. But the question is it going to stay cheap because it's cheap for a reason? And that's the fact that there's this constant erosion of per share value, or eventually is there going to be a catalyst that's going to drive it forward to help create value?
That's right.
So,
yeah, I mean, that's yeah, exactly. It's one that I continue personally to hold on to it because the price relative to those cash flows is very reasonably priced in an expensive in an elevated market, expensive, elevated to expensive market. That's been a little bit cheaper recently, but elevated to expensive market. But growing less than kind of GDP levels, or maybe right at GDP levels, less global GDP levels, it's just going to be hard for them to excel, and it's probably not going to be a big like one of those compounder into your portfolio,
right? Because they haven't demonstrated the ability to, like the Salesforce, to drive some growth through acquisitions. They haven't demonstrated the ability to do that, and their core business really is not growing at all. So those are some real challenges.
Yeah.
All right. Okay. Let's see here. Do you want to talk about Toro Company?
It's very interesting. Is one of the things as we were looking through the show was, or I was thinking about the show, was just to go and look at some of the best performing stocks in Stock Advisor. When we think about the performance of our scorecard, the ones that just don't seem to get a ton of respect.
Yeah.
Right. They don't get a lot. I shouldn't say respect. We haven't featured them a lot. They've done great performers, but maybe we haven't featured them, a lot. Like Costco has been a wonderful performer, but people know Costco. I still don't own it, but people know, they know it booking the same way. But then a company like Sherwin-Williams, Jason, which has been just a fabulous long-term performer. TransDigm, we've talked, I think that gets different, flooded in different conversations, but those real high quality businesses that at various points over the cycle, same thing with Cintas, over the cycle, at different points in their valuation, you buy those at good prices, and their ability to be able to compound.
Those are the compounders. Right.
Those are really fun stories that they don't, they just don't get the attention of the likes of Shopify or CrowdStrike, which have been, wonderful performers as well too.
Right. No, I think that's fair. So
Toro, if we
let it right ask about Toro. So ticker is TTC.
Yeah.
Go ahead.
Well, so Toro, they basically do lawnmower equipment.
They do the big stuff too. They do commercial stuff.
Not just stuff like in the back of my yard, like for golf courses and all those kind of stuff. They had a little, I think maybe they still do a little bit of going into autonomous kind of factors as well. And I don't know where the stock is more recently. Let's see. Let me just quick pull it up here.
They've had some. It's been a bit of a cyclically challenging period for Toro.
Yeah.
And it's interesting, right? Because they break up the business in a couple of different segments. I'm going to try and pull up some stuff so we can kind of talk through they reported in December. I don't think we've heard their next, but I don't think we'll hear from them until late March.
Yeah, and they raised the dividend about 6% during that time. It's a little bit of a dividend player. Stock hasn't performed all that well over the last few years, but you do get that little bit of dividend yield, which is nice.
Yeah, revenue was up in the fourth quarter. Their margins got a little bit squeezed. So California is a really big market for their professional business because it's a large business, and California is going through this. They put some regulations in place to transition a lot of the commercial business away from combustion engines to battery powered equipment because of noise and air pollution. And so they've been one of the leaders in developing commercial solutions that are battery powered. So there's a little bit of a transition that's happening in that business that's been, it's kind of affecting them a little bit, but it should be a long-term, it should be a really good tailwind. I'm trying to find their breakout by segments. So
Yeah,
forgive
I
me.
think. Oh, it looks like I'm frozen again. Can you hear me, Jace?
Yeah, I can hear you. Your
What's
audio is
going
good,
on?
but yeah, you're
Yeah, I
frozen.
heard some a little ping, and then all of a sudden I just froze. I'm not sure what's
For a
going on.
second, I was afraid I put you to sleep with your eyes open.
No, not at
all
all.
right.
And maybe I'll just hop back in again. But everything, the
No,
volume sounds good. I just can't get the cameras for some reason. It's never happened. This has never been happening before.
well, the good thing is the frozen screen. It's not like you're not making like a weird expression or anything.
Well,
So it's.
I made this quick point that I may hop in and hop back out again, but
Okay.
it is I think the big purchases have been a struggle. Like people aren't necessarily making these big purchases anymore, Jason.
Right. So their residential, I have it on the screen now. This is their residential business. So I guess this is the fourth quarter. They reported back in mid-December was up, 4.5%. So it was growing, but it was definitely affected. And here's what I'll be interested to see when they report next. The warm early parts of the winter in the Northeast and in the Midwest affected their business. I'll be interested to hear if the story is different because it's been very snowy and very cold since they reported in a lot of those markets. But they're dealing with, like a lot of companies, increased costs weighing on profitability. But this is really the sweet spot here. This is the part that's doing good, is the professional business. It's delivering. It's been strong, and it looks like it's going to continue to be strong. Not only were sales up, but operating leverage kicking in, right? You get better margins. Their earnings, their net margin in their professional business increased pretty substantially. So go ahead, Andy.
Which is great. I mean, that's the more profitable side of the business. It's just that I think.
Well, yeah, it's about 85% of the business too. It's much larger.
Yeah, and so like on the margin, maybe the large purchases from everyday users is just not as strong as it probably was before.
Yeah. So the question, under the radar, underperformer.
Well, I think probably both in the near term.
Yeah.
Longer term, not as much. And we had looked at this. I think, oh my God, I'm frozen again. What is going on, team? I'm sorry. I don't know what is going on with my.
You sound good. Yeah. Keep talking.
Yeah, it's just the is that the cyclical nature of it just wasn't one that we wanted to really highlight again as a top buy in Stock Advisor.
Right. I mean, that's the risk. That's part of the risk with a company like like Toro, because their seasonality and their cyclicality, right? So both of those things combined can create a scenario where you get a lot of volatility in the stock. I'm going to share it on the screen again, just because it's so important to realize that this is what you're signing up for with a business like Toro. Is you're going to get extreme amounts of volatility. So of course we had the pandemic, right?
Yeah,
which created volatility. And then it sold off a ton, along with so many of the other tech stocks. But the interesting thing is that it was here. It was later in 2022. It was like October 2022 when the market broadly bottomed. Toro bottomed a little bit before that and just skyrocketed because they had some good results. But then we've seen over the past year, even though the fourth quarter was good and it flipped, and their consumer business was a little weak, but their professional business did really, really well. For the full year, that professional business was not good, and it just started to turn at the end of the year. But because of that negative trend with the larger part of their business, it's been a tough period because of the cycle. Again, the cycle has not been great. So here we are with a stock that over the long term, I want to show this. I think this is just so important to remember. Again, that looking over a 10-year period, total returns of about 10%. That's roughly the market's average. It's underperformed the market over that period. But again, we're looking at it from a cyclical. I don't want to say this is a low, right, Andy? Because like you said, there's a good chance that it's going to be both under the radar and an underperformer in the near term, because there are still challenges with the business, the impact of tariffs, all of the macro concerns that could cause the stock to underperform. But looking out 10 years from now, over the next 10 years as a long-term investment, I think it's built in a way to continue to create value and to be a compounder. But you have to be able to hold a cyclical business through some pretty tough periods to get to those returns.
Yeah, I think that's right. And that's right. And right now they're facing some of those, even though they have a partnership with Lowe's kicking off. It just, they're in that spot right now. Which again, it's for us. It's like, I think about, if it's capital at risk, you could have a decent performer, you get that dividend yield. They're going to increase the dividend over time. They have for the last 16 years. But you're not, it's not one that is like pound the table, I think, attractive.
Right. Yeah. No, I think that's exactly right. Right. Okay.
Jason, Jeff
has Fulio's. Go ahead.
No, go ahead.
So did you see Fulio's comment in here? This is maybe the best comment of the day so far. We need to pair Andy with someone with the initials DC. Call it the ACDC show. So it's you and Dan Kaplinger. It's that easy. There you go.
Get Dan and I together. Jason, Jeff asked about EQT issuance of shares to pay down debt will affect my share price thesis.
So EQT, the natural gas company.
The natural gas company,
which
has done very well.
Yeah. Yeah. Great leadership.
They made a big acquisition. They've integrated
the pipeline business, integrating that in creates a lot of value through the cycle of gas prices and demand.
They said 90% of that now is integrated, so they still have a little bit to go. They're starting to see the benefit. The expectations is they will generate a lot of cash going forward. And then use that cash in different ways. I think any company, Jason, that issues shares, they're giving part of the company away, and you expect a return for that from your employee base. Or more dangerous, if you're giving out shares to make acquisitions, although lots of companies, do it, including EQT, and to make a big merger. And Buffett has talked about how that was one of the biggest mistakes he made. I think they made one acquisition with stock, and he still gripes about that in Berkshire's history.
Well, so they used they've done it twice now. They used it for Burlington Northern Santa Fe too.
Okay,
and that one worked out. I will point to, you've read The Outsiders, right?
Yeah.
Such a great book. And the idea when it comes to buying stock or issuing stock, using it as a tool, a capital tool for your business, is kind of the same idea as with debt, right? If you're borrowing money or using your free cash flow. Such a great book. And I encourage people to read it. And so that book is an analysis of a handful of different exceptionally good CEOs across different businesses and different industries, looking kind of for maybe some common themes of things that they did. And one of the things that we learn in that book about these exceptional CEOs is their talent at capital allocation and being open to buy your stock or sell your stock. Whenever it's the cheapest, you buy it. When it's the most expensive, you sell it. And using it as a capital tool. So for EQT, the stock at the time when they announced the deal to buy the pipeline business, which they knew better than anybody, because part of it, the Rice brothers. Thank you. The Rice family built it and owned it, right? So they knew those assets incredibly well.
Yeah,
the stock was near a 52-week high when they made the announcement, and they did it. The stock dipped from there, but I think in terms of thinking about the valuation of the stock, was still pretty richly valued, if we're being fair. And I think that's a smart time to use your stock for an acquisition, particularly if you think the cost of capital and the weighted, average cost of capital and the rate of return you can get on that capital makes sense.
Yeah.
And I think you've got the right people making those calculations, running EQT.
Yeah, and what you like not to see, but we see it all the time, is companies making these big buyback announcements when their stock's at all-time highs. I mean, NVIDIA just did it, but NVIDIA is probably a story amongst themselves. But other small companies, do that to issue stock when their stocks are, when there's, I'm sorry, they buy back the stock when it's at these really high prices,
Well, we've even
Just
seen
rad.
winners. We've seen big winners do that. You can go back to
Sure.
the year of the Quickster debacle at Netflix.
Yeah.
That summer, they were buying stock back, and this is the split adjusted prices back then in the 300s.
Yeah.
And then they ended up issuing shares that same year,
Right,
at like 60 or 70% less.
right. So now that obviously Netflix has worked out exceptionally well since that time.
Right.
But you want to see companies, buying back their stock when it's attractively, when they think it is attractively valued. It's one reason why you haven't seen Berkshire buy back a lot of stock last quarter.
Right.
I think that he just didn't think it was as attractively valued as it has been in the past.
That's exactly right.
Yeah.
All right.
Jimbo says, any foreign stocks under the radar? In general, they are cheap, but are there any that will not stay cheap for the next 5 years? Jason, the one that I have followed, thank you to Yasser, who helped me understand and better, and that has done very well, is Saab. It's traded in Sweden.
The aerospace
not
company.
The Saab car company.
Right. It's the aerospace company. Right.
It's the aerospace company in the defense business. It's really heavy in defense.
Yeah.
And the stock recently did a nice little pop. I think on part of the news of some of the geopolitical factors clearly that is impacting them. But they do have a lot of contracts with the U.S. military as well too. But they trade in Sweden, so Americans have to buy it on the Swedish exchange. At least that they may have a pink sheet that's very illiquid, but it's a large company. It's very effectively run, and they are providing more and more defense systems, both big platform as well as little platforms, to more and more global clients, and that's gonna be a nice continued drive for them. It's not one that we've championed and pounded again, just because it is tied to some of the more geopolitical factors. But what they've been investing in, their asset strength, their management team, to be able to make smart decisions across their platforms, has been really, really good. So Saab is one that I think is kind of interesting on the international front, that I think very, very few of us own.
So Saab does have a couple of over the counter tickers. One is SAABY, and I'm just going to mention that one because that's the one at the highest daily volume. And over the past 30 days, it's averaged 102,000 shares a day. I want to put that in context.
Yeah.
eBay has 4.5 million shares a day that trade hands, right?
Yeah.
That is a thinly traded ticker, even at 100,000 shares a day. So
so we when we recommended it, we ended up buying the shares on the actual Swedish on the Sweden exchange. But it's a lot more difficult. You have to do it during market hours and all that kind of stuff too.
Market hours there, and your brokerage makes, some brokers allow it and some don't.
100%
charging you in fees and commissions.
Currencies, you got to buy this. You got to buy this the Swedish kroner, I think it is, and then so it's not the easiest one to do, but it was just one that more and more Yasser and I talked about it. It was for a smaller position, just seemed attractive, and the stock has worked out well. And now it's just tied into the continued funding of trying to figure out how to defend Europe against everywhere, themselves, as opposed to having to rely as much maybe on the United States. But like I said before, they also serve the United States, which is a little bit of a risk depending on what we do with military.
With spending,
budget.
Spending levels come down. They're one of the more kind of edge case providers, so it could be affected. I think that's right.
Yeah.
All right. Let's see here. First Solar. Let's too many stocks to mention. Says superficially, First Solar looks really cheap. Is it a value trap? I think we could put it under the same under the radar or underperformer. And broadly, if you look at most stocks related to renewable energy, they've not done well since the election. And a lot have done really, really badly for even longer. If you look at the Enphase and SolarEdge, some of those companies that make the electronics that are really exposed to residential solar, the past 2 years almost have been absolutely brutal because residential solar demand has weakened substantially because of a number of reasons about the rates
Yeah.
that you can get from your utility to offset the cost.
Yeah, especially in California. Especially in California.
California, part of Europe has been affected.
Yeah.
I think Arizona to a certain degree, which is a pretty big state for solar in terms of percentage of households, but also interest rates. I think interest rates, that's probably 60% of it.
Yep.
You know,
exactly.
30% of it is.
So the same thing impacting companies like this is the same thing that impacted in different ways MedPace.
Yeah.
The companies too.
Yeah. So. Right. So you kind of put all those things together, and that's what's affected the solar stocks broadly. The interesting thing for First Solar is that its business results have been incredible. It's gone through a large amount of growth. Its order book is massive. They've got somewhere between 5 and 6 years of manufacturing capacity already booked, fully booked. They're expanding their manufacturing capacity because demand has been so strong. And it's a reminder that all stocks in one industry are not created equally. And in the case of First Solar doesn't do residential solar. Their entire business is utility scale solar, the entire thing. And while interest rates are a big lever for that business, hasn't been impacted anywhere near the same way that residential solar has. So the other thing that I want to bolt on to First Solar here is that as a long-term stock, you compare it to almost any other stock in the solar industry, and this is the one that has consistently made investors money over long periods of time. That's
the last
outlier.
Yeah, last 5 years is up 200%.
Yeah. Last I checked, that's pretty good. So my answer to is it a value trap is, like all things with these cyclical stocks, in markets like this where we think of solar as like high tech, but it's really just it's commodity manufacturing at the end of the day.
That's
it's a race to the bottom of cost per watt in a lot of ways. With a long enough holding period to get through like the cyclicality, because again, their demand has been really good, but orders last quarter were not enough to offset the orders that they fulfilled. So that their total backlog did shrink a little bit.
Yeah.
But and here's another thing too, Andy, they're rolling out the next step change with their technology with the I can't remember the exact word, but so they use this thin film, it's cadmium telluride. And there is a lot of research that's been done into this technology of this kind of material that can be coated over the panels that helps concentrates the particular spectrums of light that are most effective for the panels and will increase efficiency. And I'm just drawing a blank on the name of the word here, but they've already announced that generation. That's what they're working on next. So with any technology, when you have the current standard that's getting ready to be replaced, there's the potential of some of your customers delaying decisions until that new technology is available. So part of what we've seen with the stock is concern with exactly that it's going to maybe potentially up in some of their business in the meantime. But they've navigated these model changes like 8 times over the past 15 years. So they're really, really good at doing that. And I think over the long term, I keep talking about the stock, Andy, and I want to add a little bit to my portfolio. But I do think First Solar is really, really attractive right here and going to be an under the radar winner.
And they also they have spent a load in CapEx, which they might not have to spend.
It's because they're bringing those new facilities online.
Exactly. So this is something that I like also about what we're seeing for the Trek story, which is probably a little bit, well, actually it's half the size of First Solar, but might be more well known to
because you see it at Home Depot, you see it in Lowe's, right?
Yes. So right, exactly. Like you said, First Solar, but First Solar is a $15 billion company in
perovskites.
Right.
It just jumped into my head. Perovskites. That's and it's just a crystalline material that's something it's crazy to me how these things that seem like they come out of nowhere. It's like, how do we not know these things? And until we try them, we don't know.
Yeah.
So their panels with perovskites are in the works. So.
Right. So you spend $1.5 billion in CapEx to bring these facilities online. And for Trex's case, they did it with their Arkansas plant, and they're not going to have to spend $500 million in CapEx next year, or in 2026, like they might have to. And they'll have to maintain them, but that's going to be more and more cash flow for shareholders. And so for First Solar, it's just, I mean, the pricing around this is driven, so the stock price is driven around so much around the cyclicality of the business.
No, I think that's exactly right. So there's a little bit of the story there with Toro, right, where it could be both for a period of time.
That's right.
But again, that's the reality with every stock we ever buy, Andy. We don't know what's going to happen in the short term.
No,
we own them for long-term returns.
Yeah, and I've said this, Jason, with you and with others. It's like, well, housing stocks, the housing market probably is not going to be great for the next 6 to 9 months, 12 months, maybe even longer.
Yeah.
But sometimes the best time to buy these companies when they're coming off their highs. Cyclical companies coming off their highs, the valuation gets more reasonable for a market that isn't that is shifting and changing for whatever macro factor, and you can buy stocks sometimes very astutely at good prices for those who are looking to be a 3 to 5 year holder.
There you go. Jimbo has a question weighing in on the perovskite coating. Thank you. Engineer, scientist, physicist, or a very smart person that reads stuff, anti-reflection coating, they can tune it for different lambdas to increase efficiency. So love it. So again, the key there is that it allows for increased efficiency versus reflecting of sunlight away. So that's fantastic.
Jason, it is from the underappreciated or under followed or just not as well invested into. Something like looking at some of the Stock Advisor past performers that have bubbled up in the best buys now, past very good performers that have bubbled up in the best on the top rankings of the last few months, I think is a great way to maybe flag some ones that are potentially good investments for long-term shareholders.
Yep, absolutely right.
So I talked about
Andy, what you see next here?
There was Vihan asked about thoughts on Intel, Houlihan Lokey at current prices. Where do you use and where do you see them in 3 to 5 years? Gosh, Jason, Houlihan Lokey, HLI is the symbol. It has been just such a great performer and a great stock for those investors. For those who don't know, Houlihan Lokey is an investment bank, investment firm that specializes in small, medium size markets.
That middle market, that's where they are the leader in transactions.
So their primary businesses are things like valuations, restructurings, those kinds of things for the small and medium size parts of the market. By volume, number of deals, they're the leader of all the investment banks out there. They're the leader, bigger than Goldman and Morgan Stanley and the like. It's just that they focus on smaller parts of the market, so the dollar deal is just much less.
Well, the interesting thing too is that while they do that, they've also been right in the middle of some of the biggest restructurings that we've seen.
Yeah, that's right.
Right. So it's interesting that mostly is lots of the small deals, but then when there's something big that blows up, they're probably going to have some of their people that are participating.
Yeah, smaller on the merger, on the M&A side.
Yeah,
smaller on the M&A side. Yep. That's really their bread and butter, and they've been around since 1971. And they're very well run. It's a relationship. It's still to this day is a relationship business, and people like having those smaller banks that they can rely on. Companies, smaller companies that they can rely on. The stock's pulled back a little bit. It had done very well. It is now a $13 billion business, and the stock is at 170. It had gotten up as high as almost 200, I think. And so at that point, it got up to about 190, and then it's pulled back over the last year, then gone back up because the performance has been so solid. The neat thing with Houlihan Lokey, Jason, finally, that I like is that they play on both when things are going well and then when things are struggling. So restructuring, like you mentioned, and then they also have M&A. the IPO market being frozen has been an impact a little bit from them too.
Right.
But, so again, that's a little bit of a catalyst. It's just that I think the stock had gotten a little bit ahead of itself. It's pulled back, much more reasonable. Now it's at where it was back earlier this year. So I think it's again, not one that I would be pounding super excited to buy, but if things just kind of continue to go along, the stock gets a little bit cheaper. That last quarter they reported was really impressive.
So yeah, there's a couple things. So they're the corporate finance business, which that's the M&A business, right? That's kind of the core bread and butter. That is their biggest business, and it's likely to always be their biggest business by far. We're talking like between 55 and 65% of the business most years. When things are good, it moves into that higher end. 2022, it was 70% of their business. And that year, I think, set maybe some unrealistic expectations. Because it was such a good year. And even while other parts of the business did well in 2023, 2023 was kind of a bit of a nadir. Even though it was a better year than the company in terms of revenue, probably better year than any year that it had ever had. Right. It was a big year for the company. But going back into 2024, early and mid 2024, management was saying, look, the direction is, the winds are shifting, things are getting better, and we're positioned to really leverage the people that we have, because this is a Rolodex business. It's really built on the people that they have.
Still, even in technology-driven landscape, it still is a people business.
It absolutely is. And so directionally, we're seeing the same thing, where the tides are favorable for more activity in corporate finance. If we see things get weird with the economy, where it continues to get weaken, where it weakens, if some of the worst case scenarios, Andy, play out, with some of these things start to leading to more businesses that end up on the ropes, they do, like you said, depending on where we are in the cycle, those things do play into favor one direction or the other for Houlihan Lokey. And the key is that they have the talent, and no big superstars. I think none of their people are worth more than maybe 2%. Even their biggest performers are worth less than 2% of their business, their book. So that's really, really important. But directionally, the business. But I agree. This is not a cheap stock. You have to be mindful. But I do think it's going to be a compounder. I do think over the long term, from these prices, patient investors that are willing to be mindful of opportunities to dollar cost average into it probably are going to be happy with it.
Yeah, I mean, it's when we were really started to really learn about it and invest more of it. It was in the mid-teens kind of multiple level, Jason, and now it's at it's twice that. So I just think it's not one that I think, because again, it has the ability to compound so effectively, and
valuation matters a lot, though.
Yeah, just for like really going in and buying more. And I know it's all capital at risk, and we've talked about this. Whether you're buying or selling, it's the same. It's same dollar as if you were holding it today or as if you were buying it. But for building out positions, I just think it's probably not the one that I would turn to first.
Agree.
But from continuing to follow and watch how they continue to deliver across those three businesses, especially if the market, if interest rates, again, it's one of those interest rates environment starts to shift more in their favor, they're going to benefit on that.
All right, we got a few more questions coming in. We got about 4 minutes left here. I want to take John Gagos here, and John is poking fun at me over my flannel. I have lots of blue in my wardrobe and lots of blue flannel. I can't help it.
Nothing wrong with some blue flannel. I have, Jason, next time we're on, I have a blue flannel shirt like that, and I will wear the same blue flannel.
We're going to call it the Blue Flannel Hour. I love it. I love it. So,
John Gagos somehow.
Yeah, there you go. So John Gagos says, my biggest underperformer stock is Brookfield Infrastructure. And I will tell you, this is thinking about cyclicality. One of the challenges is looking hard at yourself in the mirror and saying, is this stock that I love, is it an underperformer, or is it just the timing and the cycle and all of those things, and now it's under the radar, and I think it's built to be a winner. And I think across the Brookfield entities, Brookfield Infrastructure, Brookfield Renewable, because of higher interest rates and cost of capital and concerns about renewables and global GDP and spending and tariffs and all those things are weighing on perception of these businesses right now. Brookfield Infrastructure and Brookfield Renewable, both last year was the best year those companies have ever had. Ever had. And you look at where their stocks are and there's a dislocation. So being mindful of the business versus the stock is always important, and looking backwards and also looking forwards and thinking about, is the business aligned going forward to generate returns for me where the stock is today? So it's hard to do. What about,
I mean, that is the question.
It always is. Yeah.
Right. That is the question.
Andy, do you know Trisura? John
Canadian small insurance company. Small insurance companies are not, I mean, Kinsale was about as small as I would kind of go. They don't, even though, I mean, the Brookfield family, that's great, but it's not one that I know well, and it probably, I have to look more into it, but not one that, just small insurance companies are a little bit, they spook me a little bit.
Have you had a chance to look at Burford's own earnings yet?
Oh, I haven't looked at the earnings yet. BUR is Burford Capital. I have not looked at their earnings yet.
So Mukund, stay tuned. Other fools, including me, will eventually get a chance to take a look at it, and we'll talk about it then. All right. Anything else? We got a minute and a half left before Dr. Brian Arelli hops in. And who's
Rose? Rose asked,
I believe.
Yeah, Rose asks, what fallen darlings of the post fill-in strategy era have gone on to be great performers? Well, there can be great ones. Sorry, I'm frozen there again. There can be great ones, Jason. You name one. I mean, like post financial crisis.
Meritage Homes.
Yeah, Meritage Homes and MTH has been a great winner during that period. And like, I think those are times when the markets are going through lots of different dislocations that you can really find some, but it's hard. Mentally, it's hard because everything else is going down.
Yeah, no, that's exactly right. Ryman Hospitality Properties, thinking about buying that in late March 2020, has probably 6x'd since then. The market was convinced that the business was going to die during the pandemic, because when your business is operating hotels and event centers for corporate events and industry events and trade groups and that kind of thing, and we're moving into a COVID remote world, there were a lot of concerns that the company was just not going to be able to survive because, well, there was no revenues coming in, no cash flows coming in. So that was the challenge that it dealt with, and has been a huge winner. So thank you so much, Rose, for that great question. Waiting on Brian, and I believe Carl, I think is Carl going to be joining you. So those are a couple that come to mind for me. I could easily come up with more, but
well, Andy. I just, again, it's hard because when you're in the market, the great financial crisis, it was very stressful, and it's like, do I want to put capital to work in this? And this is why we saw that PGI, the potential growth indicator, jump so high, because so much cash went into the sidelines. But those are when I go hunting for the compounders, Jason. Those are when I'm just like, what businesses? I mean, Houlihan Lokey went from 100 during 2022, went from 110 down to about 75. And then it went from 75 back up to where it is today. So trying to identify those compounders when the market is just, and the stock was selling at 13 times earnings. Those are to have the fortitude to be able to do that, to rebound. And the market is full of them, but it really takes the conviction to be able to stick with that long-term investing approach. And that's why we do shows like this, to try to help that during those times.
Yeah. Knowing the business, knowing the industry, understanding the risks, those things inoculate you against the volatility. They give you the ability to hold, as long as you have the financial ability to hold, right? It's aligned with your goals and your money needs. That's a key. Last one I'll throw out there before, as we're waiting on Brian and Carl to join us, Andy, is the banking crisis we saw back in March of 2023, I believe it was. It felt when we saw
22. Wait, I'm sorry. Was it 23? Maybe it was it? Yes. Anyway, the market had done very well in 23, but was it I think it was 22. Yeah, Silicon Valley Bank.
Yeah, Silicon Valley Bank. What's the big New York-based bank?
I want to say Citizens, not Citizens.
I'm drawing. So those were the two Those were the two by market cap. Those were two of the biggest bank failures in U.S. history.
Yeah.
And we First Republic in California. Failed. So Jim Gillies talks about, running from fires and running towards fires.
Yeah.
I was absolutely running towards the fire of the banking crisis.
Yes.
And there were so many deeply discounted, like below, like 35% below book value, really good, high quality banks that did not have anything close to existential risk that you could buy and hold through the panic.
Yeah.
And make good returns. So there's almost always something to buy.
100%. And this is why these markets I find really fascinating to start. We didn't talk about many big tech, and of course, it's the topic of our hour was underrated or underperformer. But we didn't talk about a lot of the big tech ones because the values are starting to pop up in the other spots that we like.
Yep.
Right. And in that banking crisis, and I think it was 2022, because that's when the interest rate environment started to shift.
Yep.
Jason, and that really hit the banks. You were pouring through the books of the bank, the book value, what was on the books,
it was 2023.
bonds, right? 23.
It was,
and it was just it's really hard to stay invested unless you have a mentality of like, I'm really in this for the next 5 years. And
right.
that's what you're trying to do. And under the radar, underperformer companies, especially under the radar ones that you like, no one else is really tends to not really talk about them. Not always, but tends to not really talk about them at parties or among your friends, text groups or whatever. No one's really talking about ones that are, down 50%. But like we said with Zoom, not every stock that is off, 80% from its highs is a screaming buy.
Yeah, no, that's exactly right. Stocks go up and down for a reason. It's our job to dig into the performance of the business first and then look to the stock price to determine if what's going on makes sense or not.
Yeah. I mean, sometimes the catalyst is the stock price.
Right. No, that's exactly right.
And you got to get into the business.
Yeah, no, that's exactly right. Andy, this has been a lot of fun. Brian Orelli is here. I don't see Carl. Brian, would you like one of us to hang tight with you, or are you good to go?
Yeah, if you want to hang for a minute or two. I think Carl says he's on his way, I think. So
cool. Well, Andy, if you want, I can hang out. And I could
get apologies for the camera issues that I had. Never had that before. Just
it's perfectly resolved now that the show's over, right? Now that our hours.
Yes, exactly. Exactly. Yeah. Well, no, that's great. If you want to hang with Brian and you take until Carl gets in, that'd be great.
I can do that. All right. Fool on Andy. We will see you.
Here's everyone. Thanks. Have a great hour. See ya.
Thanks. Hey, Brian, how are you, pal?
Good. Yeah.
Very good. Very good. I will admittedly, and most fools watching have ever heard me talk know that healthcare is not in my sweet spot. My wife works in the healthcare industry. So because of massive financial exposure we already have to it, I don't tend to spend much time really studying it. But Brian, you know enough for 3 people. So that's the good
great.
thing. So while we're waiting on Carl to come in, I will be more than happy to help parse through the questions with you. But before we get going, fools, always just remember, we love to share our knowledge and expertise, have incredibly bright people like Brian that are subject matter experts on to share their opinions and their knowledge. This is educational purposes only, fools. This is not individual personalized financial advice. We are not here to provide you with that. So with that said, Brian, have you had a chance to take a look in the queue and identify question number 1?
Yeah, there's one from 4 hours ago. So let me grab that one. It's from TX Ranch. It says, good morning. Is this a good time to jump into United Health? Ticker there is UNH. I feel like I need a shower after even asking that question. So yeah, I understand. So 1 year, looking at the 1 year chart, it's down. It's actually up year over year. So it's it ended or a year ago it was at a little under 450, and now it's at 540. But it had gotten as high as 630, so certainly down from its 52-week high. I think some of that was the earnings weren't that great. The revenue was expected to be up was up like 8% year over year, and I think some of that was revenue was up 8%. I'm not sure about earnings. The medical care ratio, which is how much they're paying out per money coming in from the premiums, was 8.5% compared to 85.5% compared to 83.3% in 2023. So they're paying out more, which means they have less to bring in to the bottom line. But if you look at 2025 estimates, they had already established them, so these aren't new estimates, but they expect revenue to come in at 450 billion to 455 billion, and they only did 400 billion in 2024. So that's a more than 10% increase expected for 2025. So yeah, I think I think there's a lot of potential for the company still, even though, I think the problem is that the medical care ratio, it's sort of hard for them to figure out in any given year, in any given quarter. So because they don't know exactly what patients' problems are going to have. So if we have a bad cold or flu season, a lot of times that will increase the amount of on the medical care ratio. So I think that's the problem with investing in healthcare insurance companies, is just that there's this variable that is really hard for the company to get right, and therefore definitely hard for the investors to get right. And so while they can predict their top line revenue pretty tight, I mean that's a $5 billion difference between the low and the high on a $450 billion what they think is the low. So they're able to predict their revenue quite well, but whether they can predict their earnings depends a lot on that unknown factor.
All right, Brian, we'll have wonderful news. Carl Teal is with us now, so we have two people that are qualified to discuss healthcare. So I'm going to leave it to you two guys.
Thank you, Jason.
You got it. We'll see you on the other side.
All right. Brian, it's good to be here.
Good. Yeah, I'm glad you were able to join me. Sorry.
Yeah. So I see we've got some questions going. I don't know if there's anything you wanted to dig through right away, but I mean, there's one I see right here from Anuj that's asking about Humacyte. Carl and Brian, what do you expect from Humacyte over the next year or so in terms of business execution?
Yeah, I mean, I think so this is the ticker is HUMA, and this is the company that is developing artificial blood vessels. So they take a tube when they're manufacturing it, they take a tube and they could coat the tube with cells, and those cells express proteins, and then they wash away the cells. So all they're left with is protein. So it's non-immunogenic, and they've gotten it approved for revascularization for major traumas. So, you get in a car accident, you get a big slice in your arm, or you're at war and you have a big explosion in front of you. And so to make sure that you can get blood back to your extremities, either your arms or legs, they use they have to repair the blood vessels that have been broken. And the way they would normally do it is they take a blood vessel out of your like leg or some, if it's your arm, out of your leg, and then they use that blood vessel to repair the damage. But that during a trauma, they need something as quick as possible. So they can sometimes use plastics. I think there's some pig versions, but this is a human version, and it's off the shelf, just like a plastic or a pig version would be. And so I think there's this is the first human version, and I think there's a lot of potential for it. I think right now what we should be looking for is a DoD contract. If they can get a DoD contract, and that should help alleviate some concerns about the potential market for this, and therefore whether they can whether they can market it. This is a fairly small indication, so really we're looking for, what can they do in hemodialysis. So they're using the same artificial blood vessels to create a port that then can be plugged, that the needle can go into for the dialysis, and therefore you don't, because eventually if you keep, uh, uh, sticking yourself, the nurse keeps sticking yourself twice a week, 3 times a week for, forever, in perpetuity, then eventually you can't do that anymore. So then they have different options for how to create ports, and a lot of them either get infected or get clogged up and therefore can't be used. And so they're trying to create a new way, and that definitely seems to have less infections. It's still waiting to see whether they can prove that it doesn't get clogged up as much as the
and I wanted to say about that, just I think what's going on with Humacyte right now is they got the approval for the vascular trauma indication. I think if you look what they say, they think the size of that indication is, the stock is it kind of went up after the approval and it's gone back down again, and it's certainly not a highly priced company right now if they can do what they hope to do in the vascular trauma. But I think what's going on, I think there's a lot of doubts, I guess, about the dialysis indication, just because they're still doing the studies, but in some of what they reported to date, they had good rates of patency. If I'm recalling this correctly, they have the good rates of patency, they have good rates of infection, but they actually had kind of a lot of clogging events. And I think there's the worry that the data we've seen so far is not going to cut it. And I think that's what's going on with Humacyte right now. So a lot's going to kind of ride on what they can come out with. I mean, the company itself is saying that they think they can move forward with this, but obviously, you need to see something more convincing if you want people to really adopt it in the market. And so I do think there's a question right there.
Yeah, I mean, I think they were sort of trying to cut it between maybe obese people, they seem to think that it was working better in people who were overweight and obese, and so maybe they were going to run a study in just that indication. But once you start doing that sort of thing and playing with the data, it becomes a little challenging to figure out whether they'll be able to be successful in the end.
Yeah. It's probably another relevant question right here, also from Anuj, that asks about thoughts on TG Therapeutics, TGTX. Is it fairly valued? Is it a good time to start a position? TG Therapeutics is up 18%-ish today on some really strong fourth quarter results. Briumvi, am I pronouncing that right? Is their MS product that they're selling, and it's one of these things it can be really hard to anticipate an event. It's basically, it looks like it could be a best in class product in a very, very large market, a very, very profitable market. But it was a matter of having slightly fewer events over a long period of time, and there was I guess some questions about well, how clinically relevant are prescribers going to find that? And I think it's it's proven to be doing really, really well. It's getting some strong uptake. It keeps kind of surprising people. And I mean, its sort of two main competitors are kind of an $8 billion annual sales kind of area. So even though I think I don't have the numbers in front of me, but I think it was a little over $300 million in sales this year.
Yeah, 310, and they're guiding for this year for 540 million. So,
right. So the idea is
a substantial increase there.
Yeah, absolutely. And the market cap is somewhere in the 5 billions. That's a pretty steep price to sales multiple for what they're expecting this year. But the idea is this is a huge market, and if they continue to ramp this and they continue to get sort of regarded as the gold standard, they should be able to keep growing this for quite a while. So I mean, I've seen peak sales estimates in the sort of $3 billion range. If you think of that, then the $5 billion current market cap doesn't look unreasonable at all. So, I guess, if I were looking at opening a position in it now, I guess I would probably move slowly, but I don't think it's I think given the promise of this product, it's not an unreasonable valuation. And I think they're this is ultimately where the rubber meets the road. I mean, there's a lot of times you hope for a successful clinical result and you get it, but you still don't get the result in the stock price that you want. I mean, actual sales is where the rubber really hits the road, and they're doing very, very well in that area. I don't know. Do you have any different thoughts, Brian?
I mean, yeah, I guess it's just it's the timing. Let's just assume they're going to get to, a couple billion. Maybe not. Maybe 3 is extensive, but even if it's 2, and you figure that they deserve a 10x, price to sales ratio, that's still plenty of upside. So the question is, how long is it going to take them to get to 2 billion? And if it takes a long time, then the return isn't that great. And if it's, fairly quick, then the return could, easily beat the S&P 500. I think, the question is how much can they do with their intravenous version, and how much is it going to take for their subcutaneous injection? So subcutaneous injection means it just go straight into the arm, just like think about something like a vaccination. That just they're sticking in your arm, and you just they inject it all at once and you're done. Versus a intravenous where you have to sit there for a certain amount of time and wait for the medicine to go through your system over time. And so obviously there's a convenience factor there, and there's a subcutaneous version in the same class that's already on the market. So clearly they could take some of that market if they can get the subcutaneous version approved, but they haven't even started the clinical trial yet. So they got to get the clinical trial done, and that can take some time because you've got to wait for events. But maybe they don't. Maybe they can get it approved simply based on the amount of drug in the system, since they've already proven that the intravenous version works. So I mean, I think if they can get it approved and get it approved fairly quickly, then that's another opportunity to increase the growth rate.
Yeah. Here's an interesting and timely question from 307 Fool. It says, thoughts on HIMS, that's the ticker, the company is Hims and Hers, and how compounding of GLP-1 drugs might change revenue going forward. So this was so Hims got really, really just blasted down over the last week or so. In a move that I thought, I don't know. It seemed so obvious that this was going to happen, because it was basically FDA declared an end to the semaglutide compounding, or not. I'm sorry, not to compounding. Let me take that back. Announced an end to the semaglutide shortage, and that is kind of what was the justification to allow compounding of it to happen. Hims was already out of tirzepatide, and that shortage was declared to have ended, a while back. And so now it's, they're basically the two main drugs are sort of off limits, but not exactly. And this is what they're going to do. The reason that compounding exists is that you are serving patients who cannot be served by the commercial product, right? So you say something like, I'm allergic to propylene glycol in the auto injector, I can't use it. And so a compounding pharmacy can make a version without it. Or what I think is going to be their main strategy going forward is, I can't take the approved doses, so I need a custom dose. So I think what happens going forward, and what Hims has said is, we're not going to, basically we're not going to stop selling semaglutide in the, commercial doses, basically. So they're going to, I think, continue to sell custom doses. And obviously they have their own, telehealth aspect to the company, where they can, kind of help guide that towards like, oh, maybe you need 6 milligrams instead of 5 or 10 or, whatever it is. So, I think that's how they managed to keep doing this. They've also said that they're going to probably be doing liraglutide, which is generic now. At least the Victoza version of it, which is for diabetes, is generic. So got to tread a little bit carefully on that. But so I mean, your question was, what impact does this have on revenue? I mean, it's obviously down, but not to zero, right? And I can't, there's certainly, it's not going to be as big a part of the business as it was. It was like 15% of the business. I mean, I don't really have a comment on whether Hims and Hers is a good investment, but I mean, they have, other parts of the business that are around mental health drugs and hair loss drugs and other
erectile
stuff.
dysfunction.
Yeah. So, I mean, all that's going on. So, this isn't really a comment necessarily about where Hims stands as an investment right now, but, their GLP business is going to drop, but not go to zero.
Yeah, I think that's a fair assessment. I don't really have much to add there. Sanjay asks, can a biotech have too many drug candidates in its pipeline such that it doesn't have enough resources to pursue all of them? And then does BioNTech, ticker BNTX, I think it's BNT, is it BNTX or BNT? Yeah. Have too many drugs in its pipeline. I mean, yes, I think there is possibility for companies to have too many drugs in their pipeline. I'm not exactly sure how much cash BioNTech has, but it's certainly quite a bit. So I'm not sure that BioNTech has too much in its pipeline that it can't meet its demands. But any thoughts on that, Carl?
Sorry, I was muted there. Yeah, I mean, BioNTech has a really huge pipeline. They have a huge pipeline in part because they have a huge pile of cash. A lot of it's early stage. I mean, this is kind of obvious, but the expense of developing these drugs ramps as they get further advanced. So you can have a pretty rich pipeline of sort of, preclinical investigation stuff and even some phase 1 stuff and not necessarily burning that much cash. There's assumptions that certain things are going to fail and get winnowed out as you move along. It's a piece of, I think you find with companies like this, you've seen this recently with some of the, I don't know, Intelia is coming to mind, which basically, had a more extensive pipeline of stuff. They basically just kind of shut some of it down, not because it wasn't working, but because they have to think about how their cash is going to work against these timelines and everything like that. BioNTech doesn't have to make that kind of decision right now, but they certainly can. This is a company, like, if they really wanted to be profitable around their ongoing vaccine business, they could cut down all kinds of stuff. They don't want to do that right now. I don't think that makes sense right now, but they have a lot of optionality to, sort of put on the back burner some of these programs if they need to. Right now, things are going pretty decently for them in the clinic, but I guess that's mostly what I have to say about that. Too many is always an option. Another example is I think of is Exelixis, right? When they were bringing cabozantinib to market, they were really, really tight on cash at one point, and they basically gutted the entire pipeline. That was a company that used to have an extensive pipeline and basically got rid of the whole thing in order to put all their eggs in that basket, and it worked. That's something that companies have to face from time to time. Luckily, BioNTech in particular is not in that position.
Yeah, they haven't reported fourth quarter earnings yet. They do that in a couple of days. But in the third quarter, they had 17.8 billion euros. So that's right around the same amount of dollars in the third quarter. So, still substantial amount of cash that they don't have to worry, and investors shouldn't have to worry in the least bit about them, having to pick and choose what drugs they want to move into the next phase. Basically, anything that's positive can be moved in the next phase for now. At some point that might be that might be an issue. But hopefully at that point they've also gotten a second or third drug approved, and therefore have more cash coming in, and therefore more the ability to continue growing their R&D budget.
All right, what do you got, Brian?
Let me. Jimbo asked what percentage of our portfolio is in cash right now. I don't actually know off the top of my head, but it's probably not very much. It's I certainly don't. I tend to, as soon as I put cash into my portfolio, go and buy something. That may be the total stock market index, or it may be the Russell 2000 index, or it may be an individual biotech or healthcare company. But I don't tend to change my cash position based on what I think the market might do over the short term, because I'm a long-term buyer. So I figure, I could be right or I could be wrong. And so I don't tend to do that. I mean, like I sort of like, I was pretty sure the pandemic I was pretty sure that I knew that we were gonna have a crash before the pandemic, and I didn't pull my cash out. And I would have been right to pull it out, right, and bought back at a lower price. But then the question is, like, when to buy back in. We had sort of a pretty close to a V recovery after the pandemic.
Right.
And so, I probably would have.
And I don't think many, that was really hard to see ahead of time. Like, oh, I'll bet the stock market, absolutely plummets and then comes right back again. Like, I don't think many people.
Yeah, I mean, I sort of like when I had like a inkling when I was writing so many articles about this, potential, virus in China, and it was clear that it wasn't really being contained, and could, it was going to start spreading at some point, and the stock market hadn't reacted yet. And so I was like, this is probably going to cause the stock market to go down, but I just chose not to at that point sell, because I figured I wouldn't be able to get back in at the right time. And I definitely don't think I would have. I mean, I would have probably been like, oh, it's gone up a little bit, but that's probably just noise. It's gonna, it's potential to fall more. Maybe we'll trade sideways for a while, and then I just wouldn't have bought back in. And so who knows how well I would have done, even if I had sold, and been right on the selling part. I don't know that I would have been right on the buying back in part. My guess is I wouldn't have been. So I figure it's just easier to just continue to buy. As I get closer to retirement, I think my thought process is probably going to change there. But right now it's, be 100% invested in the stock market at all times. And, the only time I have cash coming, I've cash coming in that I put in every month. And then there's cash from dividends and sometimes sales of companies that end up getting sold, end up getting acquired. I tend not to even sell too many companies, so I don't end up generating cash that way either.
Yeah. And so my answer to the question, which I will make super brief, is I also don't have an exact number, but I would guess it has gone up. I do have more cash now than I did before. It's probably in the 20%-ish range. And it's not about like, oh, I think something bad's coming, I'm going to sell a bunch of stuff and raise cash. It's not really that. It's more about like, I've been putting some cash in and just not investing it yet. A lot of that just has to do with looking for the right thing at the right time. A lot of it is honestly just, like I just, it's not any grand strategy. It's just that I tend to do these things, when I get at specific times and make fairly big moves, a few times a year, rather than do it on a sort of more disciplined basis, which probably would be a good thing. But I mean, I have made a few sales of just things that I personally was a little, overweighted on. I have, a fair bit in NVIDIA, for instance, and I've moved back just a little bit on that to be cautious. So some stuff like that have kind of raised cash in my portfolio that I just haven't chosen to reallocate yet. I expect I will find some opportunities this year, however. Let's see, what else do we have?
Jimbo asks about Chinese pharma and pharma-related companies. I certainly don't invest in any. There's Beijing that changed its name, right? They either has or was in the process of changing its name to something else. That's certainly, if I was going to invest in a Chinese biotech, I would definitely go for a large Chinese biotech because I would just feel more comfortable with investing in a company that, without, having that extra layer of the SEC, makes me feel a little bit better about investing in biotechs. And so I think I would tend to not want to invest in a small, early stage, not profitable biotech, or, not having revenue biotech company personally.
Yeah. I guess I don't have that much to add on there. I mean, there's just biotech's already risky. There's kind of an added element of risk there just with the relationship going. Not to say that there haven't been some really, really good plays there, but yeah, that's not an area. I've done it before. I mean, and it's been okay, but that was years ago. I've been a little more, I think, cautious just about that recently.
Yeah. And I would just note that like Beijing has like changed its, like they're trying to separate themselves from China. So like when you look at their dateline for their press release for their third quarter, it says San Mateo, California, not Beijing, China. And they're planning on changing their name to B1 BE and then capital ONE. And the ticker will be ONC instead of, I guess they've already changed the ticker on the NASDAQ to ONC.
And I just want to, just the way you're saying it, it sounds a little bit like you're saying Beijing, the city, as opposed to Beijing, the company, just in case anyone was confused.
Right. The city, but they were in Beijing. Right. So that I think it was supposed to be a play on words somewhat, or maybe not.
Oh, I assume it was. Yeah. I just didn't want anybody to be.
Yeah. So BEIGENE is the name of the company currently, although they're changing it to B1 BE and then ONE.
Yeah. So there's a question here from Mandeep Kalsi that is, any thoughts on Iovance Biotherapeutics? So they did not react well to earnings. The stock has been doing very poorly. They are on the market with Amtagvi for melanoma. I mean, here's kind of the challenges for this product. It's difficult to manufacture, and so getting decent margins on it is difficult. It has been in demand. It does work very well for some people, and it is in development for a number of further indications. This tumor infiltrating lymphocyte approach. So it's not really. Amtagvi has not been doing terribly. I mean, it's ramped, but the growth rate has slowed to the point that I think people are looking at it and being like, well, it's not really, given margins are improving, like everything's sort of coming along, like they've improved their margins. It is growing, but not fast enough that people see that sort of path to profitability, I think, until we see further indications. And, so, I mean, I think it's not surprising that people are a little bit cautious. I mean, to me, that's kind of a more cautious sort of, hold on to it. But I'd be cautious about putting more money into it probably at this point until I saw something else going on that gave me a little more confidence. I don't know. What do you think about that, Brian?
I mean, their fiscal year 2024 was. Revenue was 165. Oh, that's just the drug itself. So total revenue is expected to be 450 to 475 billion in 2025, and they're expecting to burn less than 300 million. But again, as you point out, this is not a high margin business because they have to make it individually with each individual.
Right, and you hope the margin gets better over time. It should.
Yeah. So, but they only had 160. Yeah. So they had 164 million in guidance, which was at the upper end of their guidance of 160 to 165 million. So, and then they're expecting to jump all the way up to 450 million. So does not seem like a pretty solid ramp, or no?
No, that seems like a great ramp, but I think some of that is based on some further approvals. Honestly, this is one I have not, like, I just looked at their headline numbers and I have not dug into what they said after the quarter, and I need to do it. But yeah, I mean, I think, yeah, if they really ramp the way, you know, if it's sort of like, oh, 450 this year, 700 something the next year, I mean, you could see them turning a profit by 2027, and the stock's like $4. They don't, you know, that starts to look like an attractive PE multiple without that much on the bottom line. So yeah, no, they could be really solid, but I just think there's a lot of questions about manufacturing, about whether they're really going to be able to hit those numbers, just because of I think the growth rate just modulated a little bit in the fourth quarter in a way people were not comfortable with. But I mean, it is one I do want to dig in further. So if you want to, you know, ask that question again later on, I will have taken a further look.
Yeah, they do say they're trying to get gross margins up above 70%, but they also know that that's over the next several years. So,
Right.
you know, and clearly that's some of that is going to be through, you know, just you know, the underlying costs that are fixed, and so therefore they have to increase. They have to, you know, they're counting on the revenue increasing to allow them to grow that. It's not that they're going to be able to lower costs at the same revenue level. They're gonna have to increase revenue level, and then the percentage of the cost of the total will go down. And then the other thing I would note is that they only have 422 million in cash right now at the end of February, I guess. So,
Yeah.
you know, that's quite a bit, but, you know,
Yeah, it's
when
not a
they're
terrible position.
right. But when you're, you know, when your margins are less than 70%, and you're looking to burn, you know, you're looking for 450 in sales and 300 and burning 300 million, I think that means you're going to be burning some of your revenue. You know, you're going to be burning you're going to be burning some of the cash. You know, you're not going to be profitable in 2025 for certain.
Oh yeah,
You know,
definitely.
so not, you know. So even though the revenue's, you know, fairly high, you know, it's percentage wise, not that much is going to drop down to the bottom line, and then you're going to have to use it for research and development.
There's a question here, a couple of questions actually, about companies I don't know super well. I mean, we can just sort of there. So N2201 asked about a company called HealthStream. I mean, I just kind of looked. They're a SaaS company that it looks like it's dealing with sort of human resources personnel stuff around healthcare workers, if I'm looking at their profile correctly. I'll be honest, I don't really know anything about that company. Do you, Brian?
Was that HealthStream?
HealthStream, it's HSTM. Let's take a look. So it looks like it's a company that's been sort of posting since the pandemic, since 2020, that's kind of little under 5% top line growth a year. Much better on the bottom line, although the projections for this year don't look quite as good. You know, they're profitable, so you know, so that, I mean, I don't have a ton of cash, but that's okay. They're turning a profit. Kind of looks like they're trading a little over 3 times this year's expected sales, and for not great margins. You know, it's tough. It's just it's actually, those are, I guess the thing I would want to look at is, for a SaaS company, those are not very good margins. Particularly on the, well, yeah, I mean, it's not even really great gross margins, and it's certainly not good EBITDA margins or anything like that. It's just surprisingly low for a company that's described as being in the SaaS business, which is not like I'm literally just looking at this for the first time now, so I'm not drawing any firm conclusions here, but that would certainly be something I'd want to look at.
In Need of Input asks about ClearPoint Neuro, ticker is CLPT, and long-term prospects. It looks like they fell quite a bit on their fourth quarter fourth quarter revenue, which was up 14% year over year, but it was only $7.8 million, and the company is valued at $382 million market cap. So that's a substantial price to sales ratio, even if you multiply that by 4, so in 2023 they did 2024 for the whole year they did 31.4 million, and the growth seems to be slowing down, so that for all of 2024 revenue was up 31%, and then in the fourth quarter it was only up 7.8%. They are cutting their cash burn, so in 2024 they burned 35% less than they did in 2023, but they're still burning cash, and they and then they only have 20 million in cash at the end of 2024. So I think that's the reason why it's gone down, is just that I think there's some worry probably that they're gonna run out. They're gonna have to raise some cash fairly soon. So they used in decrease. Oh yeah, so they used some debt and then used some cash to pay for operations in 2024. So I don't know this company that well. Obviously I think they have like a like cage thing that they put around your head, and then that allows them to deliver the medicines, I think, is what they're mostly focused on.
I think I think that they have a few different delivery technologies, but yeah. Okay. Here we got a new question in from No Noise. It says, Brian recently noted that one of his biotech favorites is Vertex, but I'd like Carl's thoughts too. Yeah, this is one of my favorite biotech companies as well. It's all it's pretty bulletproof in some ways, which doesn't mean that the stock's also done very, very well, but the main things you have going for Vertex, I guess, is this. One is obviously the cystic fibrosis franchise is, they're essentially without rival in it. And even though in a sense obviously there are barriers to entry in terms of patents. And in that regard, the company now they just at the beginning of this year got their latest drug approved. They're now, at the point where they're looking at sweat chloride levels as an endpoint for their studies, which is something that it's hard to, you're basically, these studies used to always measure FEV1 or something else that's just like direct lung function. And right now it's like getting hard to improve on that. So you're looking at sort of things like sweat chloride levels that are more of an indication of the underlying disease, and they're improving on that. Now they have patent protection out to the 2040s, I think, with their latest drugs. So, you start looking at them as being almost a monopoly with very, very long limits on the lifetime of these drugs that they can sell. It looks like a very strong position. So I guess you think about, well, what could disrupt them? Possibly a gene therapy, but I think gene therapy has been really, it's been a business in which there's investment has fallen anyway, just because people have been not in love with the commercial model of it. But also it's just been really, really hard to deliver drugs to the lung. The company that I think of that's trying to do it is a company called Crystal Biotech, because they're using a herpes virus to deliver to deliver a corrective gene therapy. But the way that works, that wouldn't be a one and done cure. So that would be another treatment. And then you have to ask, like, is that going to be better than what Vertex is doing already? Or would Vertex just buy it? They have a ton of cash. I see their cystic fibrosis franchise is pretty strong from everything that you can see right now. I guess the only thing I would say is I'm a little less sure about the pain drug. The suzetrigine was just approved. It was approved for acute pain. So this is kind of like you had some, surgical procedure, and they would normally, send you home with 5 or 7 days worth of hydrocodone or something like that. But instead they could send you back with this drug. And the point of this drug is that it's not working the same way. It's not working on opioid receptor. So it's not really, doesn't have the potential for the addictive impact. And that's great. But, generally speaking, people aren't really worried about a 5 to 7 day course as being, a huge addiction risk. Now, it's really great. It's great that it's out there, because people who have had past addiction problems, like now have an option to be like something post surgery that they don't want to get opioids, which I think is really valuable. And they haven't priced it like outrageously. I think it's $15.50 a pill. So if you're taking a couple of days, you're talking about like $31 a day for however long. Maybe they end up prescribing a little longer than you would a course of opioids. And there's a lot of these procedures. It's like something like 80 million of these a year. So it is a big market, but I have questions about how that's still, hydrocodone is, a couple of cents. So, or 25 cents or something like that for a pill. So, I mean, it's way, way more expensive. And I have some questions about how much doctors are going to do that. So you really look at like, well, what's the chronic pain market look like? Because that's where it really makes sense, where it's be like, look, you have chronic pain issues. You don't want to be on opioids for, a period of years. That's not going to work well. And just their clinical results has just been more equivocal in that. I mean, the last round of results on, I think it was sciatica, came out looking like they just didn't really outperform placebo on it. So that just looks a little more questionable to me. So that specific market is one where I kind of have to wait and see.
Yeah, I haven't been as bullish on the. I mean, I've been at a wait and see on the pain medication, and I think investors seem to be pretty excited about it. And
Yeah,
it's sort of the one knock that I would say on Vertex right now is I don't think it's very cheap. So it's trading at 11.5 times sales, and if you look back to like 2021, it was down at 7.5. They were just trading at 7.5 times sales. And I think the cystic fibrosis market had a bigger potential in late 2021. There was still potential to add a lot more sales in late 2021 than there is now. That they've basically gotten almost every cystic fibrosis patient on their drugs. And so I would look for pullbacks if you're going to invest, especially if you're going to buy a big amount. I probably wouldn't do that right now. I would probably look to, if you don't own it right now and you like its prospects, I think the biggest thing would be to buy it in thirds or whatever and invest, at different time points to try to get a better price to sales ratio than the one that's available to you right now. Hopefully the pain medication does well, and I think there's potential that doctors might just prescribe it just because they don't want the liability. Even if it's a small likelihood of percentage of patients that have surgery and then end up addicted to opioids, I think there's enough that you might want to go ahead and do it for most patients. And so therefore, especially if it doesn't cost that much more for the patients, and insurers might also just put it on their lowest tier for the patient, the cost may not even be that much different because they may be paying, the copay for the generic versus the copay for the drug might be pretty similar. And so I think that there may be a saving grace for Vertex, is that patients and doctors and insurers may drive sales more than patients and the efficacy, just because it's a different mechanism of action.
Yeah, and if that so yeah, that's exactly, yeah. If it turns out to be like really more popular than I'm expecting, that's upside for them. And I will point out they do have other stuff going on. I mean,
Yeah, they have a
they spent
kidney
a lot of money
disease, right?
acquiring. I'm sorry.
They have a kidney disease, right? That's coming.
Right, inaxaplin for APOL1 mediated kidney disease. I think probably going to get clinical pivotal results. I mean, on that in like early 2027, late 2026. They shelled out $5 billion for Alpine, or nearly $5 billion for Alpine, which is certainly a lot of people had questions about. But that they have a phase 3 study going on that's a dual BAFF/APRIL inhibitor for IgA nephropathy. So I think they're aiming at a 2027 approval there. Still working on their phase, their diabetes. Basically making pancreatic islet cells, introducing them again to kind of address type 1 diabetes, has moved along quicker than I thought it would. I'm not sure what the timeline is for that, but that's obviously that's an exciting program. So, I mean, it's a super high quality company. It's not as cheap as it's been. And, I would think you're getting a fair margin of safety.
Yeah. And then of course you got that. I don't think we even mentioned sickle cell and
oh yeah,
thalassemia with CRISPR therapeutics.
Just to bring up some other recent news. I don't Bluebird so on the same day that Cascavy got approved for sickle cell and beta thalassemia, so did Bluebird Bio's gene therapy. Bluebird Bio just got taken out by private equity company for I think $30 million up front, and there's a payout if they can reach $600 million in sales in any 12-month period before the end of 2027, I think is the terms of it. Then they get this other payout. But the other payout is still, it's like, I don't have the exact number. It's like 60, 70, 80 million, something like that. Like it's like really kind of sad, honestly, what happened to the company. I mean, it was like they were scientific innovators, like virtually everything they did succeeded in the end, and this is what happened to them. But like just the way the market regards them versus, I mean, Vertex still communicates very much optimism for Cascavy. I will say this about Cascavy, just a thing to think about coming up in the near future. A lot of people who have sickle cell disease, who have beta thalassemia, and who have these other like long-standing genetic disease, hemophilia, whatever, not that Vertex is in that game, are on the Medicaid program, right? So often if you didn't start on Medicaid, you end up there because these are incredibly expensive diseases. Sometimes it's even a strategy to do what's called a Medicaid spend down of your assets so that you qualify for Medicaid, so that you can handle the expenses of these diseases. Current budget calls for $800 and some billion in cuts to healthcare spending. I don't know if that's going to happen. Just passing the framework for that budget was incredibly controversial. That barely happened. So whether anybody really does this is a big question mark. But if it does happen, I would say that those cuts are going to come out of Medicaid. They're not going to come out of Medicare. And that being the case, if you have to make extremely painful cuts to Medicaid, I would think that there would be more emphasis on new money toward new things rather than taking other stuff away. So, I mean, it's just another risk, I guess, to the broader adoption of Cascavy. I mean, in the meantime, it is something like, 40% or something of people are on private insurance. So, I mean, there's a lot to be tapped. So I'm not saying it's, a complete disaster waiting to happen or anything like that. But I mean, it's a significant part of the market that is kind of facing a near-term question mark right now around the budget.
Yeah, and so then the ticker for Vertex is VRTX, just to make sure everybody got that. And then Sanjay asked an interesting question that I hadn't really thought about, but he's comparing Vertex to United Therapeutics, and notes that United Therapeutics has dominated the pulmonary arterial hypertension, so PAH. As much as Vertex has done with cystic fibrosis, what are the prospects for United Therapeutics? I think it's an interesting question because I like Vertex and I haven't really been super excited about United Therapeutics, and I was trying to think about why, and I think it's probably mostly the pipeline of drugs that Vertex has versus the pipeline of drugs that United Healthcare has. I think would be the reason why I'm not as excited, because they don't seem to. I think they've got. Yeah, they've got, looks like one, maybe. Oh, I guess maybe they've got a couple programs that are in late stage development outside of pulmonary fibrosis or pulmonary hypertension. I think they've mostly been able to be successful with just one drug that they've revamped into different ways
Tyvaso's been really
ways they've delivered it, and so that's why I haven't been super excited. But they're trading at a price to sales ratio of only 5.2 versus Vertex is 11.5, so certainly much cheaper valuation given to United Therapeutics, and I think that's the reason why I'm not as excited about its potential growth.
Yeah, I mean, they are certainly not unreasonably priced. I mean, I think the market is probably maturing. I mean, it's maturing for Vertex too, but it's smaller, right? I mean, they're looking at sort of three-ish, a little over $3 billion in sales this year. Obviously, that's significantly smaller than Vertex, but I mean, they're quite profitable and not at an unreasonable valuation. But yeah, I guess I'd go along more or less with what you said. If we can see them pump up the pipeline or show us something exciting going on there, I think it might motivate investors some more.
Yeah, I was looking at Mankind the other day, and I hadn't been following the company for very long, and apparently they did a deal with United Healthcare to deliver that drug that treats PAH, that they had already gotten approved as for whatever other delivery method, and they're getting 9% royalties. Mankind is, and the drug is like a multi-billion-dollar drug, so they're doing quite. Mankind is doing quite well. They're bringing in like $100 million in royalty, in basically gross margin free royalty, 100%, into the bottom line royalties off of this United Healthcare drug, which I hadn't realized, and certainly it's doing much better than Afrezza, their inhaled insulin is, and much better than their they have a patch as well for insulin, and both the the royalties on the PAH drug are better than the total sales of the other drugs that they wholly own. So I thought that was interesting.
Yep. Let's see. There were some other. I just want to see if there's some of these older questions are around. Looks like maybe those got answered. I know there was a question here that I didn't get to last time I was on that was about cytidine.
Carl, take your time and find it. We will happily banter while you identify that question.
Well, it may have been answered, but I can talk about it just briefly anyway, because it might be illustrative of some other things. Which is just that this is a company that had a lot of legal problems in the past with their former CEO. Now, I'm not saying that bears through right now, but it's I don't want to put this the wrong way, but it's just like when you look at biotechs, like there's plenty of reasons to not invest in a lot of companies. So look for those first. Like if you see a whole bunch of like screaming red flags right off the bat, go ahead and pay attention to those. There are higher quality companies that you can look for. And Cytodine is just one of those tickers, CYDY. It looks like it got answered though.
Yeah,
it was one of those that raises
6
enough
days
red
ago.
flags.
I found it. It was from Ken, 1952, 6 days ago. So we can check that one off.
All right.
You win the prize for the longest question sitting there in the queue.
All right.
Well done.
And here we are at past the hour so quickly. So great to see you guys back again, and have a good show.
Carl, Brian, have a great rest of your day.
Thanks, guys.
Hello, Jeremy Bowman. How are you, buddy?
Good. How are you doing, Jason?
I'm good. I'm excited to be on with you. We were supposed to be on a day last week and something happened and I wasn't able to be there. And luckily somebody was able to pinch hit. I'm glad to be back in the saddle with you, my friend. How are you?
Yeah, doing well. Yeah, I think, we had a fun session last week, I think, right?
Yeah, we've had an hour, but it's time to get more of those hours. So I'm excited about that. This is the valuation hour here on Fool24. I'm Jason Hall. He is Jeremy Bowman. Is always at the top of the hour. In addition to the theme, we'd like to tell you where you can get questions to us. If you are just finding Fool24 for the first time, welcome. We love answering questions. We want to answer yours. Fool24 is your event code. Go to slido.com to get us that. Always, too, just remember, this is for educational purposes only. We don't know your situation. We don't know your individual needs. We haven't spent the time to understand those things to provide you with personalized financial advice. So this is not personalized financial advice. Maybe it's good and it can help you inform your own decision. But again, that's not what we're here to do. So please remember that. All right, Jeremy, this is the valuation hour. Have you had a chance to see if there are any questions that you want to answer, or is there a topic you want to start with?
Yeah, well, not too many fresh questions in here. There's some interesting macro kind of ones, but I can do a little valuation ditty if that works for you.
Do it. I think so.
Off.
Yeah.
I mean, we're here to talk about valuation, right? So the stock
how do you think about valuation? What are you looking for? And give us an example.
Yeah. Good question. Yeah, let's start off on highlight. I think valuation is one of the trickiest concepts as an investor because it's very tempting to just want to look at, price to earnings, or if that doesn't work, maybe a price to sales or another figure like that, and think that alone will tell you if a stock is cheap or not, or how the market views it. And I think it's really only one piece to that puzzle, and you often you want to compare it to the peers and think about what sector it's in and what is baked in to that valuation. I mean there's value traps out there, right? There's stocks that seem cheap and are for a reason, and then there's high price stocks that just keep going up.
Right. For the same, they're expensive for a reason. That's right. Exactly. Yeah.
Yeah. And I think it's, you also want to compare the stock valuation to, where it's been and that sort of thing. I mean, I think in some ways that can be the most useful comparison if, sometimes the stock is cheap relative to, where it was a few months ago or that sort of thing.
Yeah, that can definitely be useful. All right, is there an example jumping out to you that you want to talk about?
One of the more interesting stocks, I think on a valuation basis I've been following is ARM Holdings.
Mm-hmm. Ticker ARM.
ARM,
yep.
Yeah, ticker ARM. ARM is a pretty major player in the chip sector. What they primarily do is CPU architecture. So they're found in almost their designs are found in pretty much every smartphone. They have a market share of over 99% in the smartphone market, and they're in a wide range of other devices and cloud servers. The embedded appliances and infrastructure kind of thing. They tend to compete. Intel and AMD make the alternative CPU architecture, which is called x86. So that's their most direct competitor on that front. But they also have a very interesting business model. So what they do is they license. So they sell a license to say NVIDIA, who they work with, or some of the big cloud companies. They're in Amazon Graviton, Apple, that sort of thing. And then those companies will make the chip with the ARM design, and then they'll collect royalty revenues. The ARM will collect royalties once the chip goes to market or the product with it starts to sell. So it's a tricky company to value, I think, because their revenue stream is delayed. So when they sell a license, they often won't collect royalty revenue for at least 2 years, because it takes a while to bring that product to market. But so just and it's the stock has come down quite a bit. Still pretty expensive stock on traditional metrics, trading at about I have here on Yahoo 38 times price to sales price to sales ratio, and a trailing P of close to 200. But I think what investors want to understand about this company is that and their royalty revenues, these things last a long time, and they tend to come up with a new version of that. The latest version of the CPU architecture is called V9, and they also make something sort of a more complex or more developed system they call compute subsystems, which has double the revenue of the V9, double the royalty of the V9 chip. But so half of their royalty revenue currently comes from designs that are more than 10 years old. So I think ARM, I mentioned what really makes their CPU architecture special is that it's battery efficient. The company started actually it's a battery company, I believe. So that's why they're in all the smartphones. They really have an advantage over that x86 alternative. They're gaining more adoption in AI, but I think they're really this. And the stock is expensive, but I think it's a bit of a hidden sort of long-term play, because I think their chips, they go in the cloud. They also can go on edge devices, which include phones and anything else that the user uses. Edge AI is sort of really just starting to develop. So I think we'll see a very long-term kind of growth stream from AI for them, as some of this new license revenue flows through to royalties.
Yeah. I was going to say the thing that I love about that, Jeremy, that breakdown is, like you said, valuation is one of the more complex, complicated parts of investing. And the way that I think about it is, a lot of times investors, and this is my experience, so I don't want to insult anybody when I say this, but I think broadly, my first few years when I was really trying to find my sea legs as an individual investor and sharpen my skills and figure out what to do, I was like somebody trying to be a carpenter that had no idea what tools were. And I would stick my hand in the bag and I would grab the tool that looked most closely like what I thought that I needed to use, until I found one that felt like it was the right one. And I think sometimes as investors, we do the same thing. We spend our time trying to find the valuation metric that tells us we should buy the stock, instead of listening to what the metrics are telling us, which might not be the answer that we want to hear sometimes, right? And the next part of that is doing what you did, is not just looking at the backwards looking metric that tells us where is today's stock price based on last quarter or the past year's financial results, but being able to take today's price, the context of the prior results, as giving us, like you were talking about, like a benchmark for where has the market historically wanted to value this business, and then understand where is their business. ARM was a perfect example. What is this business likely to generate in future results? What future earnings am I buying at today's price, right? That's what we're trying to arrive at. And it can be really, really challenging to get to that number if you don't understand the business, the implications, their order book, the cycles for the industry they operate in, the headwinds and tailwinds. If you don't understand those things, we just look at what Yahoo Finance or the screener on your brokerage, what they tell you. It's almost always just looking back, or it's a collection of analyst estimates for adjusted earnings over the next 4 quarters. And that's as far as we get with actually arriving at anything close to valuation.
Yeah, I mean, it's very different. We'd all like to know what the future earnings from any of the stocks we own as well. And I know some maybe some people are more thorough about it's a good exercise to do. I think you can do a reverse discounted cash flow and that sort of thing to see what kind of earnings it would take to justify current valuation. But it can be very hard to predict, especially for the long-term future earnings.
It absolutely can. So there was a question that came in about Brookfield Corporation. This came in. When did this come in? This came in about 5 hours ago from BG. But this is right in the wheelhouse of our show and me as somebody that follows these businesses closely. So BG writes, any concerns on BN Brookfield Corporation valuation? And this is exactly one of those that is a company that, depending on which metrics you use, can make a stock look crazy, scary, expensive. I'm going to do a screen share here, my friends at Y Charts. So I've got 2 tickers here for Brookfield. I'll explain why in just a second, but I have the purple blue one. This is the ticker that trades on the Toronto Stock Exchange, which is really the native exchange for the company. And then we have the New York Stock Exchange. And by both of those, we're talking, almost 200 times earnings for the Canadian ticker and almost 100, over 187 times for the US based ticker. And the difference here is this is the US dollars versus the Canadian dollars. So that looks wicked expensive, right? For a large, mature, profitable company to be trading at that. And if there's one thing that I've learned, so fools, here's something to put in your valuation tool bag. If a company's PE ratio or price to free cash flow ratio shoots up sharply, and over that same period of time, the stock, and in this case, you do see the stocks are up, but they're not up nearly as much as those valuation metrics are. It's time to start digging in and figuring out what's going on with the business. And then a lot of cases you'll have maybe large non-cash things or complex transactions that have happened that have played a role in causing the valuation to shoot up maybe a lot more than the stock has gone up. And in the case of Brookfield Corporation, it's a little bit of that transactional noise that's happening. Brookfield Corporation recently did a transaction with Brookfield Asset Management, the asset management business that it owns the majority of, that makes the numbers look a little bit off. But at the same time, earnings per share or net income isn't necessarily the best metric to use to understand, to arrive at a valuation for a company like Brookfield Corporation. It's a little bit like a REIT in the way that, and also the way that Warren Buffett tells us with the Berkshire Hathaway net income, because there are a lot of assets that it owns a stake in that, because of accounting regulations in Canada, in its case, it has to report unrealized gains and losses. And as as investors, we know if you had to report your taxes every quarter based on the unrealized gains and losses in your portfolio, it's very, very noisy, and it's not reflective of like the long-term value creation of those investments. So for that reason, and others, distributable earnings is what I do think is a better metric to use for these companies. And they report, there's 2 different ones. There's distributable earnings before realizations, And then there's distributable earnings, and that's after realization. So if they realize a large gain or loss, because this is a fairly, I don't know why that won't, there it goes. Fairly transaction heavy business because of the way that it's structured. You get a much different number. So you see $1 a share in distributable, or excuse me, $4 a share in distributable earnings per share in 2024 compared to, I can't remember where the net income is. I'm going to jump out of the slide share because I don't want to make everybody dizzy. But earnings per share was closer to $1 than that $4 a share in distributable earnings. Now that's $4 Canadian, $3.96 Canadian. So you would take to get to the valuation. I'm going to do the screen share again here. And I'm going to show you those stock prices for those two stocks again. So the Canadian shares is the one that's about $82 a share. We see it right here. So at roughly $4 Canadian per share in distributable earnings, the distributable earnings PE ratio is in the low 20s, right? So you arrive at the more appropriate metric for this particular business, and 20 is a lot cheaper than 190, right? Call it 22 or 23 times. So I think you're starting that, getting to that, low 20s distributable earnings PE ratio. Thinking about, is that expensive or reasonable for a business like this? So a very large business, it's very profitable, very cash generative. So you have to remember that distributable earnings number, a lot of that is the distributions that they get from the other Brookfield entities, those subsidiary businesses, the distribution they get from the dividend at Brookfield Asset Management, very cash flow heavy businesses that they get. And a lot of the distributable earnings comes from that. So, that's steady, that's dependable. And then you look at the growth rates and the size of assets under management that they continue to acquire to the asset management business, the growth opportunities for their operating units. Like Brookfield Renewable signed a deal early last year with Microsoft that one deal would grow their entire production, all the power production from all of their power generating assets by like 37%. That was one transaction. So over a 5-year period, they're going to deploy those assets. But the point is, you kind of bolt all of the tailwinds together behind infrastructure, renewable energy, the energy transition broadly, the growth of private debt, the opportunities in real estate, their insurance and reinsurance business. You put all those things together, and this is a business that should have the ability to grow its distributable earnings per share at the low teens rate. I think is a reasonable level of growth. Being able to buy that for low 20s multiple, I have zero concerns about Brookfield Corporation's valuation right now, and a lot of faith in Bruce Flatt and his team's ability to grow the business and continue to create. These are value investors at their heart. So yeah, no, I think the valuation right now looks, it's not cheap. I won't say it's cheap, but I think it's perfectly reasonable for an absolute top tier business.
Yeah, I think you made some good points too there about, sometimes with these more complex businesses, it's you have to just decide what the right metric is to use in valuation. As it's not always going to be earnings per share, right? In a company like Brookfield, distributed earnings might make more sense, or cash flow, book value,
right?
Certainly a company like Berkshire Hathaway, there are going to be a number of ways to unpack valuation.
Right. Yeah. Buffett tells us operating earnings is the key thing there, because it excludes those non-realized gains and losses in the investing portfolio. And REITs, the entire REIT industry tells us to use funds from operation, which is earnings per share, backing out depreciation of real estate assets, because real estate assets tend to go up in value over the long term. So, all right, you want another question you want to grab here, Jeremy?
Yeah, there's one that just came in on Costco. Always a fun one.
Love it.
307 Fool says Costco valuation is a tough one right now. Historically expensive, but always seems to deliver over time. Thoughts on that? Yeah, you know what? I'll go ahead and do what Jason did. I got a little Y charts ready to go if I can figure this out. Yeah, I mean Costco has been a great performer. I mean, there's a lot to like about the company. Are you seeing that, Jason?
Not yet. If you've sent it through, we
chart-
got to wait for. There we go.
Oh yeah,
Screen
yeah,
share
yeah,
from
yeah. There we
Natasha.
go.
So
Okay.
there you go. There you go. Yep.
Yeah, I mean it's you know, certainly been a long-term performer. I mean, I think it's a very very strong business. But yeah, well, let's talk about the valuation first. Maybe I can make this a little larger. So you know, so what gives me concern about Costco here, you see price to earnings ratio, which I think works for a company like this, is it's all the way up to 61 now. And you know, the S&P 500 somewhere, I believe, in the high 20s. So you know, you're paying at least double what you pay for the S&P 500, which is you know, has some pretty strong, fast-growing companies. I mean, including Costco. But what gives me pause, I think, here is you see the orange line there with PE ratio. You know, you've gone from close to 30 about 5 years ago, when, you know, I guess was shortly before the pandemic started, or maybe we're even into that now. And doubling really in the last couple of years, which is, you know, you call this multiple expansion, right? I mean, a stock price can really, in valuation terms, it can go up for two reasons. It can go up because, you know, earnings are growing, or it can go up because the multiple, what investors are willing to pay for it, is also going up. So you see earnings per share, pretty steady growth from Costco. Earnings per share has doubled, you know, over the last 5 years here, but the stock price has tripled. So a lot of that is because of that multiple expansion. So I you know, that can't happen forever with any stock. I mean, it can happen for a while, I think. And I mean, I think that has happened. I mean, it's a reflection of, you know, investors are willing to pay for you know, so much for a company as, I think, rock solid and recession proof as Costco. But you know, I don't think they have the same growth prospects as a tech company, or you know, faster growing company out there.
Right.
Right.
That's
you know, 'cause
so
really,
that part is so important, Jeremy. Because it's easy to look at that and say, well, Nvidia trades for 55 times earnings, or one of these, you know, other higher growth companies, higher earnings growth companies. And again, the difference is we're paying a higher multiple for those companies because they're growing their earnings at a much faster rate. And companies that are growing their earnings at a much faster rate, you simply have, you know, more margin of safety through the earnings growth rate to still arrive at a good return. I'm going to hop into the screen share too. I want to build on this a little bit too. So again, same thing. I've got the price to earnings ratio, and I've got the price to operating cash flow ratio. By both metrics, Costco has never been this expensive. Never, ever, ever been this expensive. And it grew earnings per share in its most recent quarter by 13%, right? That's not a lot, you know. It's great for a business like this. I want a wonderful business. Revenue was up 7.5%. A retail business that's known for paying its staff a lot, having great benefits, running extremely thin margins on its products because the value prop is to pass low prices along. That's the promise. And you pay the membership, and the majority of the profits are from the membership. They make some operating margin on the goods, but it's a lot of the profit comes from the membership. Turning, you know, 7.5%, and the vast majority of that coming from existing stores. You know, you're growing your comps that much. this is your earnings growth rate, right? So that is an extremely rich multiple to pay. And it's a multiple that you're only paying because you expect a company to be able to grow into it, right? I want to make the bull case. I want to make the bull case for Costco being able to grow into it. Where this next quarter, I believe they report this week. I think they report on the 6th. Is they're going to give their Q2 fiscal results. That's going to be the first quarter that's included this increase in the membership fee. I don't think any of the first quarter had it. Maybe a few weeks up, but I'm pretty sure it's this upcoming quarter. What I'm really interested to see, Jeremy, is renewal rates. How has it affected the renewal rate? Anecdotally, talking to people on social media, people have said, when I saw how much it was going to be, I decided we're not going to renew. I think there was somebody on Fool24 that commented the same thing. It's anecdata. We don't know the real data yet. Yeah. So does that renewal rate drop below 90% in the US? I don't think it will. I think it's going to stay high because that's their biggest shot to grow earnings in fiscal 2025. Because we pretty much know what their revenue growth rate is going to be. We know the margins they get on their product. They're not trying to get more margin on the product. It's increasing the membership fee. So I think something is going to happen that's not great with the stock eventually, where it's going to come down. It's going to normalize. But yeah, I think there are too many better opportunities out there at better valuations or with a growth story that supports the valuation for Costco. I wouldn't dare suggest anybody that owns the business consider selling. But I do think whether the stock comes down or you don't get great returns over the next 5+ years because you're starting from such a rich valuation. I don't think that this price is going to work out to be a great return for investors over the near term.
Yeah, I think Costco is a good one to talk about, regarding valuation because, unlike say, it's a tech company, I think Costco's future growth is fairly predictable. They're going to open a handful of stores every year. They'll grow comparable sales, maybe 5%. You're not really looking for margin expansion, but right, they pass along membership increases, that sort of thing. Maybe some share repurchases in there. But yeah, I mean, you expect to probably see 10 to 15% earnings per share growth as they just put up. But I don't think you're going to see a big surprise from them. Barring maybe some kind of drastic change in the economy.
I think that's right. So I'm going to ask you a question to tee you up to answer it if you can, because I can't. And then I want to take Jimbo has a question. Do you follow Comcast? Is that one you can talk about?
A little bit, yeah.
Okay. So AD's thinking about Comcast valuation, which is in the high single digits compared to Costco. Is there an opportunity? So think about that. And Jimbo has a question asked, and Jimbo has asked this question a couple of other times when I was on earlier today, and I didn't get a chance to get to it. I want to now, and I have some perfect stocks to think about. Jeremy and Jason, what are the GARP growth at a reasonable price you were looking at right now? Tell us about value with good outlooks. Jimbo, I want to talk briefly about home builders because I do think there are some interesting valuations out there, but there's some big caveats that I want to put on that. So I'm building a screen share right now. I'm going to go ahead and share it as I'm adding these stocks to it. We want to talk about home builders and why I do think that there is some really interesting opportunities. So I'm just going to start with Meritage Homes and NVR. These are two foolish recommendations. These are two stocks that have been winners over the long term. NVR, one of the biggest home builder winners in forever. NVR has been a more recent winner. It's a newer company. Steve Hilton founded the company and ran it for most of the first 20 years. He's now the chairman, and the current CEO has been there for over a decade. Very, very well run. So first thing you see, massive differences in the valuation of these two businesses. NVR is kind of the gold standard in the home building industry, has an incredibly unleveraged balance sheet. Most home builders have a lot of leverage because they use debt to some degree to buy land, and they just have land until they start to develop it. And they have to pay the debt on that land before they can turn it into houses. And because of the cyclicality of the market for homes, it can really hurt these companies when downturns eventually happen. So NVR exclusively uses land options contracts, and has a pretty good history of leveraging that pipeline of options contracts to acquire land, immediately begin to develop it, build, and sell. So that helps them reduce downside risk when the cycle does turn. They also have a really good mortgage origination business that's pretty profitable. So for those reasons, that's why you get a premium for NVR against pretty much the entire industry. I'm going to throw Lennar on here too. Lennar is becoming more and more asset light. So anyway, the valuation, PE ratios for these companies is substantially below the market, right? Even the outlier of NVR is still substantially cheaper than the S&P 500 average PE ratio by a lot. I don't even know why it's not coming up. That one should come up here. Okay, there you go. So it goes through the October quarter, because I guess we haven't gotten all the companies reported yet in the S&P. So at any rate, you see it is a substantial, it's half. So if we look at these companies over the long term, though, and again, we'll pull this one out, and we can pull out NVRs too, just to kind of normalize it. You see, these are cheap by just about however far back you want to go. And what's happened that's caused them to be cheap? As a starting point, they're cheap for some good reason in the near term. There's a lot of concerns about 2025 and housing supply and their ability to build, whether we're talking about tariffs on the lumber side of the business and also the steel, the inputs, right? That it's not a massive amount of money, but it is a meaningful impact on their cost structures if tariffs do go into play. Labor supply is a big question. Interest rates continue to affect the appetite of buyers, and that's costing them profits. So there's expectations that it's operationally could be a challenging year, but also that home builders kind of have to eat more costs to be able to price homes to sell. And that's going to hit their bottom line. So there's the expectation that 2025 could be a tough year for earnings. So we never want to buy stocks for a year, right, Jeremy?
Sure.
Maybe not always. Sometimes we're experienced investors. We know what we're doing. We see an exceptional, unique opportunity to profit in a short period of time. But generally, we think about owning these businesses and being owners for a long time. So especially in cyclical industries like this, I think the thing that I always look back to with home builders is that, yes, there are cyclical risks with home builders. There always will be. But the secular need is enormous. And it's not just the total supply of housing, which is a bit of a challenge. There's limited inventory of existing inventory that's being put up for sale. It's about half what it should be to be a healthy market. But there's also a dislocation between where the supply of existing homes is and where the population growth is. So the Sun Belt, the Southeast, parts as you move further west, get into the desert Southwest, those are the areas where populations are moving and GDP is growing and companies are expanding and there's economic opportunity, lifestyle opportunity, and there's not enough housing. Excess supply of housing in Minnesota or north of Boston, where I am, doesn't answer that need. That's where home builders can come in. And I think we're still looking at a decade of need for these home builders to build into. So I would say looking at top tier builders like Meritage Homes that focus on that entry level first move up, Lennar that's become even more asset light, and even the NVRs of the world that are a little bit more like the Mid-Atlantic, but they're also pretty big in the Southeast. Those are some of my favorite home builder stocks. And for the long term, these valuations, I believe, are going to look incredibly attractive when we look back. I don't know how they're going to look in June, but I know in June 2030, they're probably going to look really good.
Yeah, I like what you're saying there. I definitely agree about home builders. A good point too, I think, to make about valuation. This relates to Costco as well. Cyclical stocks, especially maybe the riskier the cycle, which is true for home builders. The lower the valuation tends to be. No,
Costco, that's exactly right. They look really cheap sometimes when they're actually expensive in the market and the cycle is turning, and they look really expensive at the bottom when their earnings are squeezed. But we should be most compelled to buy them.
Mm-hmm. Yeah, I mean, I think that's one of the reasons Costco is so expensive is because it's viewed as a recession-proof stock, and I mean, they sort of a competitor. I think most of the market thinks it's essentially bulletproof.
Yeah,
and then you see banks tend to trade. The big banks they tend to grow, and they're good businesses, but they a lot of them trade at PE ratios close to 10.
Yeah, it's a difference in understanding the business model. It's so important. So important.
Mm.
All right. If you had a chance to think about that,
yeah, I like the question on Comcast. So Comcast, one of the larger entertainment businesses. I mean, they kind of have a sprawling empire with NBC. Of course, their cable and broadband business is kind of what they're best known for. They also own the Universal theme parks. So you can't the Peacock streaming as well under the NBC umbrella. So I don't know if you can quite compare them to Disney, but maybe they're the closest company as far as a diversified entertainment business. But Comcast,
we call it the dry Disney. They don't have a cruise line, so we call it
right.
Yeah. I apologize. I'm sorry.
That's a good one. But yeah. So I mean, I think everybody knows cable's been in decline for a long time, which has been a problem for Comcast. But you know what? The broadband business isn't very good for them either. And really, broadband has reached a market saturation point. I switched my my broadband provider a few months back, and the company I dumped was just giving me incredible offers to get me to come back, and I maybe should have taken it up on that. But I think really broadband is at this price war kind of point where there's really no competitive advantage there. Comcast is facing competition from the telecoms, Verizon, AT&T, and T-Mobile, and fixed wireless. So not only are they losing cable subscribers there. In the fourth quarter, their most recent quarter, they lost 139,000 domestic broadband subscribers. So when that's your biggest business, that's really a problem. Total revenue in the quarter, I believe, was up just 2%. I think this is a business that's cheap. It's cheap for a reason. I mean, they are profitable. They're definitely generating cash flow. It's possible that they'll come out on the other side of this kind of market contraction, or competition in a better place. But I think it deserves to have a low valuation. There's a lot of risk in that industry. That revenue stream continuing to shrink, or broadband prices being driven down by competition and that sort of thing. So.
I think we could look at like AT&T again, not perfectly analogous, but some of the capital allocation decisions that they made, and again, I think to a bigger extent than with Comcast, but they chose to make some massive leveraged bets on expanding beyond the traditional like wireline and wireless telecom business, and destroyed value, massively destroyed value, destroyed the dividend. And again, I don't think that with a Comcast you have like the same level of risk, because they have to try to figure out a way to leverage streaming if they can, whether it works directly or they need to just focus on the content and license to the other streamers. Like they've got I think that's a battle worth trying to fight, to find out if they can carve out a stake, right, of having one of the platforms. But yeah, there's risk priced in, because if they don't execute and deliver, it's going to be a value trap, right? I think that's the potential risk. The upside is there's some, right? Because you might see the multiple go up if things just get better and it does become more profitable. But yeah, to me, it's in the too hard pile. If I saw a mid-single digits valuation, deeply discounts, like, okay, you know what, there's some risk reward opportunity. But yeah, there's so many winners already in that space in streaming that it's just going to be tough for them to turn that into a massive cash cow business.
Yeah, it's a good point too, comparing them to an AT&T or Verizon, which are, those are market leaders as well in telecom, but the stocks have really, just been value destroyers. It's a similar industry, I think, as far as market saturation and a lack of growth, and T-Mobile has sort of outplayed them. And right. Comcast, media and entertainment has been tough for a lot of companies, and you look at those metrics and it doesn't look good for them.
All right, I'm going to take Vihan asked, Vihan, thank you for this. When I was talking through home builders, asked thoughts on Green Brick, talked about Meritage Homes and Lennar. So I'm going to spend a couple minutes here talking about Green Brick Partners, ticker GRBK. I'm going to do another screen share. This may be my favorite home builder right now. This is a smaller company, but they are so incredibly well run. So the management is just exceptional, and they might be some of the best originators in home building. If you look at their results, strong. I'm going to embiggen this a little bit so it's a little bit easier. We're just going to focus here again. So home closing revenue. So that's one thing you'll see with a lot of home builders is they get revenue from other sources. That's a small amount of revenue. So they focus on home closing revenue is like the core business. 24% growth in a period when other home builders were just struggling with their supply. Right, there was some demand, but struggling with supply. 46% increase in earnings per share. A lot of that was just from being more profitable, but they do buy back shares too. So that's one of the ways they've boosted their earnings per share over the long term. But here's the key: their operating costs are good, but 33% gross margins for the full year. I can't tell you how exceptionally high that is for a home builder. A lot of home builders are like mid to high teens. Usually low 20s is really, really good. If you're in the 30s, you're exceptional. And these guys, they really are exceptional. And then building on that, because we want to look forward, we're looking at a lot of orders too. So they're not just selling their inventory and nothing to go forward. 878 new home orders in the fourth quarter. That's a record for them in that quarter. Very manageable debt load. Again, think about these. They're leveraged companies broadly. Most of them use debt to some degree to buy land. Managing that leverage and not putting the company way out over its skis when you're about to go over the cliff is so important. So I think I think Green Brick is the best originators in home builders. They're just the best at pricing, building, and then selling at really good results. So yeah, I would put this up there with Lennar and Meritage. Absolutely.
Yeah, that's not a one I was familiar with. Green Brick Partners. Pretty solid. Pretty solid numbers there, though.
What's the market cap? Market cap is $2.6 billion. That's probably why don't know. A lot of people don't know about companies with a market cap that small. It's small. It's a small home builder, and they do an exceptional job.
All right.
All right, next question here.
I think I'll take this one from Jimbo. Kind of a general question here. Do you buy before earnings? Are there times you avoid buying, or times you think it is better to buy a stock you are interested in? Not timing, not asking about timing, but the signals. Personally, I don't have a rule. I mean, I think some investors don't like to buy before earnings. I mean, there's, obviously a risk that the stock could move down or up, when earnings happens. I mean, as far as looking at this from a valuation perspective, as far as my favorite time to buy, I think is when a stock you like falls on earnings, because I think and sometimes maybe there's a good structural reason for the stock to be down, but often there's just quarterly results fluctuate, and often these misses compared to Wall Street estimates are really marginal. To miss earnings by a couple cents or 0.1 or 2% revenue really doesn't matter in the long term.
Yeah.
For a good company. Yeah, I mean, my favorite approach as far as buying around earnings is to really find a sell-off that doesn't seem justified, and and that usually valuation's better and that sort of thing, and you can get it at a discount.
Yeah, no, I like that, because I mean, it's the reality is that stocks are a lot noisier around earnings, right? The moves are almost always bigger than whatever the underlying data justify, whether to the upside or the downside, right? It just tends to happen. And there's other mechanical reasons why that can affect it too, that can cause a stock to go up a lot after earnings or to fall more after earnings. The use of options, for example, for shorting stocks, and you can use options as ways to like supercharge gains or as like a mechanism that acts like a short. And then if the results doesn't support that, investors in those financial instruments want to get out of them as quickly as they can to minimize the losses, or they want to get out as quickly to maximize the returns. And that embiggens the response of the market, right? The one caveat that I'll put with that I largely agree with what you're saying, is number one, focusing on the signal matters so much, not just reacting to the stock price, because the stock always moves for a reason. Your job as an investor, as a capital allocator, is determine, number one, does the price, based on everything you knew before earnings, is the price in that moment a price you'd be willing to pay? And then you look at the results and what has changed and determine whether that remains true or not, right? In the case of the trade desk, as an example, the stock fell a massive amounts. But the story did change. Jeff Green laid out some operational problems. Their guidance that they laid out, they reduced it. They missed their own guidance. And I think it's one of a handful of times in like 30 quarters that the company's missed its own guidance. So when those sorts of things happen, you have to do the hard work of trying to get the right answer and not just do what you think you should do. You need to make sure and verify what's going on and whether things have changed in a way that the answer needs to be something different.
Yeah, that's a good point. I think also that, I wanted to say that, here at the Motley Fool, we advocate, long-term investing. And I think that's, especially around earnings, that's one of your advantages is to, because there's so many short-term trades happening during that
you don't
time,
have to do anything. You have all the ability to do or not do as you choose.
Yeah. And I think, right. And, focusing on the long term or investing for the long term would give you an advantage when there is a short term related, sort of a more news driven sell off rather than something more structural. But yeah, I definitely agree. You got to dig into the report and see what actually happened.
Yeah, there's a stock that I bought today. Therefore, I can't talk about the stock. But the stock did report. I can't remember if it was before the market opened this morning or Friday. I believe it was Friday. It reported Friday afternoon. That I had a weekend to look over the results and really think about what's changed, what hasn't changed, and I arrived at the conclusion. It's like, okay, now I'm ready. It's a stock I've been wanting to buy, and I've been able to keep my mouth shut long enough to buy it, and it just coincided with the company reporting, and I was fortunate that the stock fell today, so I was able to get a little better price than I was expecting. So the business has to support it first. So make sure that's the case before you act. All right, we got about 7 minutes and change, Jeremy, and I'm going to be trading you in for a Toby.
Okay.
So I'll be staying.
All right. Yeah.
I can grab Argonaut's question about Confluent here.
Okay.
Argonaut asked, what is your conviction level for Confluent? Ticker is CFLT, given the most recent Q4 report. I'm one of the rare fools that has continued to have consistently high conviction for Confluent. So Confluent is a software company, software as a service built on top of an open source data streaming product that the founders of the company created. It's called Apache Kafka. And they realized at some point that a really good business would be helping customers, enterprise companies, build and manage their instances of Kafka. So that was Confluent was born, and Confluent is the name of their product. And they have Confluent for businesses to run on their own servers. They have Confluent Cloud. The name tells you what it does. They have hybrid products because so many businesses in the enterprise have data that they manage locally and also data that's in the cloud. So the short version, the bull thesis is that we're going through this step change in the way companies want to be able to use data. And instead of batch reporting from lots of different programs behind all kinds of silos and different departments and divisions and subsidiaries and all of that, having the tools to stream data in real time as companies are acquiring it. I apologize. I'm having a heck of a coughing fit here. Being able to stream that data in real time as they're acquiring it is far more powerful and actionable. The bear case is you're competing against Amazon and Google and Microsoft that have their own proprietary streaming products that they've bolted onto their cloud infrastructure. Something like 70 or 80% of the S&P 500 uses Kafka at some level. So we know it's incredibly popular. And what the company's learned is that more and more companies, they don't want to build it themselves. They want a trusted partner that can build it in management, and they want to buy a product off the shelf, right? So this last quarter that we saw was a return to growth, and their guidance was for some acceleration of growth. And I think the market, I wasn't surprised at all because management's been telling us for about a year to expect that was going to happen as they lapped some other things from prior quarters. So we're seeing that expansion of growth. And we're also seeing at the same time the economic output of these companies, these software companies, as they get to a certain scale and move from cash burning to kind of get a break even to start becoming really cash generative. We've seen Confluent switch to burning cash to being able to live off their balance sheet. And they're going to generate a little bit of positive free cash flow in 2025. And they're going to be able to build on that in years and years that follow. So I have a high level of conviction that this is going to not just be a survivor, but I think it's going to be a big winner. All right, what you got, Jeremy?
Confluent's an interesting one. Yeah, so we've got 4 minutes left here. So I'll round it out with this question from Ed that just came in. Is the sell-off with NVIDIA justified? Yeah, it feels like Jason, as you and I have been talking, the the market has it's been a rough day out there. It's continued to head south. And wow, NVIDIA's down 9% today. About the lowest it's been in a few months. Of course, they had the sell-off following earnings last week. So we talked about the sort of valuation in terms of risk. So I think in NVIDIA right now you're looking at price to earnings less than 40. And that's trailing. The company's still growing very fast. They just reported 78% revenue growth in that quarter. I think what part of what we're seeing is maybe some of that magic dust is starting to come off, and growth is still very high, but it is slowing. And I think investors expect that to continue. But and then there's certainly cyclical risk, and this is a hardware company, so you expect some cyclicality at some point, the decline or certainly pullback depending on what happens in the economy or a broader AI demand. But we're looking at the analyst consensus right now, 449 in earnings per share for the year we're going into. So that's about 25 times earnings, which to me that sounds like a pretty good value for a company that I think really everybody's been impressed with what they've been able to do in the data center GPU market. I think you got to give CEO Jensen Huang a lot of credit.
Mm-hmm.
A year or so ago, a lot of the buzz was, Intel and AMD are launching their own, GPUs and accelerators and that sort of thing, and they're going to take market share. That really hasn't happened at all. And NVIDIA is, continuing to innovate. They launched the Blackwell platform. They've
it did
coming
substantially better than I think investors were expecting in the last quarter.
Yeah. They continue to beat estimates. I think guidance was solid. Yeah, really. Really, I think the sell-off was surprising to a lot of people. And
Blackwell too, specifically Blackwell. They sold a lot more Blackwell than I think analysts were expecting that they would sell last quarter. Most of the ramp ups expected to be in this calendar year, but they got a lot more traction with it more quickly than people thought.
Yeah, I can't remember what the figure. I want to say
30 billion,
but
something. Yeah, 13 billion. Yeah. It was substantial number. It wasn't zero, that's for sure.
Yeah, but this is one that I think it's going to continue to be volatile. There are a lot of puts and takes. It looks like one of the reasons they're down today is some investigation in Singapore about some servers going to China that have NVIDIA hardware that there chip restrictions on there. So, but I don't know if the sell-off is reflective of broader nervousness. But to me, to answer the question, I think it's overdone. I'm surprised by it. Are you muted, Jason?
Whoops. That's the first time I've done that in a while. I'm rookie mistake there. All right, as we get ready to move into the next hour with Toby here, I'm going to grab a quick question. Jimbo has a question asked. One more home builder here, DFH. That's Dreamfinder Homes. How does it compare to a Lennar or a Green Brick? So to hear the company's, and I own a little bit, to hear the company's management talk about it, they love to compare themselves to NVR. And for good reason, because they're building the model based on the same thing entirely, using land options to acquire land versus borrowing and buying land. And they have a little bit of a mortgage origination business they're doing as well. The difference is that Dreamfinder is actually one of the most leveraged home builder. If you look at the leverage ratios one of the most leveraged home builders of the top tier of home builders right now, because they have a lot of corporate level debt. So I don't, the way they package and promote the business is a little bit different than the actual company balance sheet because of all of that debt. The downside of all of that corporate debt versus using debt to buy land is you have land. Dreamfinders Homes doesn't even have the land because, again, it's corporate level debt that they have acquired that is just secured by the business. So the debt holders stand in front of shareholders to claim assets in like a worst case scenario. I don't think that means that Dreamfinder Homes is in trouble, but it is a riskier home builder in terms of the impact of a cyclicality hitting its bottom line because it has a lot of debt that it has to pay to service. So I think investors should just be very, very conscious of that reality. All right, so we should be getting Toby here any moment now. You see any questions you want to grab before you call it an hour?
I could take this little older one from Jimbo here. With the support of government back to the private sector and some economy numbers turning for the better, is it time to invest in China now? Chinese stocks they have done better, and I think for investors, looking for value, I mean that does, it sticks out according to those key metrics, but I don't know.
If you think you're getting what you're paying for.
Yeah, right. I'm still pretty skeptical of the growth there, and the economy is still pretty weak. We have this seemingly expanding tech cold war. I think of it as over chips and AI and all that stuff, and tariffs and whatnot. So I personally feel pretty cautious about China still, and I, especially after that whole crackdown, and just feels like a hard market to predict, I'd say.
I agree. It's the too hard pile, and China's demographics are not favorable. China's getting very old very quickly in terms of the percentage of their population. So those are things that are potential risks. So, all right, Jeremy. So let's wrap this hour up here. This has been a blast.
Yeah, and great to talk with you.
Yeah, me too. This was good. Look forward to being on with you.